Trade your prediction with IBKR Forecast Trader. The yes was recently at 60%. Buy yes or no and earn $1. If you're right, go to ibkr.com/forecast. S&P down 1.5%. The Dow down by 600 points, down 1.4%. The Nasdaq Composite Index down 1.5%. The Russell 2000 Index down 2.1%. 10-year 4.12%. The 2-year 3.87% on the 2-year. To be clear, 3.87 on the 2-year. The 10-year 4.12%. Gold up $16 the ounce, up 0.6%, 29.08. West Texas Intermediate crude down 2%, 66.99 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. Let's get right to Bloomberg Invest 2025. Sonali Basak is sitting down with Harvey Schwartz, CEO of Carlyle.
The opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession. And so it's a bit of now uncertainty. And what the election originally people grasped to was certainty. Markets like certainty. And so now we're in a period of uncertainty, and I think you're seeing it in the risk reduction that we've seen over the past several days, and obviously this morning also.
When you look at what's happening with the tariff strategy, I'm guessing this kind of comes into part of that geopolitical uncertainty. At what point are you worried about it crossing over into a tariff war? Is this all kind of par for the course what we're seeing right now, or is there a risk of serious escalation?
Okay, so tariffs are a complicated subject that doesn't really get unpacked very often, so let's just try and do it super fast, given the time constraints. But if you think of tariffs, let's just split the conversation into two things really simply. One would be, let's just say, economic policy incented tariffs, which can make a lot of sense. We have the lowest tariffs in the world. And then you have tariffs that are motivated by, let's say, political objectives, social objectives. So first of all, you have to unpack the two. This bucket, I think, can be reversed much more quickly. We've seen that in discussions and negotiations. This might be stickier depending on what's happening. But in terms of, and you asked, your language was perfect, Sonali, because the real question is, are they inflationary? And a one-time tariff, let's just say 25% on a country, a one-time tariff is a one-time step up in price acceleration. But it's not sustainably inflationary. Trade wars are sustainably inflationary because then, of course, you could perceive a 25% step, 10, 10, 10. And I think that's what the market is now responding to. But what the market's really responding to is increased uncertainty because we just don't know where the tariff discussions are going to go. It's too early.
To the point you're making on uncertainty and the earliness of the conversation, how do you think about this as it pertains to your business? Do you have to make changes? Are there portfolio companies that are structuring differently? Are there deals that you can't do right now because you don't know what the tariff impact is going to be?
So the vast majority, so for those of you not as explicitly familiar with Carlyle, we're $440 billion of assets. We're one of the largest private capital managers in the world. That's split across real estate, private equity, credit insurance, which is our largest segment, and our solutions, secondaries, and co-invest business. We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. So we don't, when we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. And so, yes, now in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, we have, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, in the PMI yesterday, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately, when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
So what are the things that you see now that investors are going to see 4 months later?
So today, nothing about today looks dramatically different than 3 months ago. By that, what do I mean? EBITDA growth is quite solid. Earnings are quite solid. The factors around input pricing, there's still marginal pricing capacity. And demand seems quite high. The consumer seems quite resilient. I think the administration inherited quite a stable economy. You know, inflation obviously not exactly where the Federal Reserve would like it, but it's come down dramatically. And so the environment feels quite good. Now, in terms of what we're seeing in that data, there's nothing suggesting today that the economic underpinnings of that have shifted dramatically at all. What you're starting to see, though, are the things I just described, which is preemptive actions around how best to position, again, around the uncertainty. The way I would describe it is, for a long period of time, you know, geopolitical economic risk tails were very tight. They're just fatter today, and we'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean. But this uncertainty factor obviously is affecting markets.
You started to hit on this a few minutes ago about inflation and worries about the impacts that tariffs would have on inflation, one time, more persistent. Where do you see the direction of travel? More recent economic data has created some cause for concern among investors.
Yeah, so first of all, we just came through an unprecedented period. And I got to give, and I know the debate around the Federal Reserve happens a lot. It always surprises me because I think the Federal Reserve and Jay Powell have done an extraordinary job navigating a massive spike in inflation. You know, we went through an unprecedented period of rate hikes. There was a big audience calling for rates back to zero. I have no idea why anybody would want rates back to zero. Rates back to zero is not a normal way to run an economy, and we certainly shouldn't be wishing for that. In terms of getting inflation down, that's a very, very difficult thing to do. And I think the Fed has done an extraordinary job. I think at this point, given we don't exactly know how the tariffs will ultimately settle, I think the inflationary question is a bit uncertain. So what I mean by that is there is a path where you could see a one-time bump in prices, assuming there's no trade war and no future escalation, that will translate through the system as higher prices. It may also cause some demand destruction, which longer term would be deflationary. And you actually could see the economy experiencing stress as it goes through that. So I would say that all the parameters around forecasting inflation, forecasting interest rates, I said, again, I just think we should all buckle up a bit because markets will be more volatile, super data centric, probably too data centric because you can't extrapolate one data point to the future, but it's going to be a sort of a wait and see. I do think the administration will be very sensitive to pro-growth policies, and so I think they'll be watching also.
So with that push-pull going on, what you're looking at is a market that has changed so drastically in terms of rate cut expectations. You had a number of investors feeling like maybe you might get a rate hike this year coming into this year, but market consensus, now you have shifted from maybe 1 rate cut to 3. Market pricing overnight went to 3 rate cuts this year.
Yeah.
Does that make sense to you? So
we were never in the camp. You and I had this discussion 2 years ago. We've never been in the camp that the Federal Reserve was going to cut rates aggressively. Our strategic economist has really nailed this. Jason Thomas, if you don't read his work, you really should. I've worked with some extraordinary people in my career, a real privilege, and he's extraordinary. But he has the benefit of rolling up all our data. So he's been saying for a long time rates were stickier. I just spoke to him before I got on the show, and he said, listen, it's more complicated now to have a very firm opinion. Again, period of uncertainty. But it's not surprising to me that the market has shifted to this because of the unknown around tariffs. And I think what the Federal Reserve has proven to us is they're very data-centric because they know they're in a situation that is somewhat novel. So they're going to be very data-centric. They're going to do what they need to do. So if you see inflationary pressure, they're going to moderate up. If you see deflationary pressure or a slowing of the economy, I think the Federal Reserve, one thing they've proven to us now for a very long time, they know how to cut rates, and they're going to cut rates if they need to. But it's not surprising to me that the market is forecasting more of that. But also, we were sort of shocked when they were forecasting 5, 6 cuts, and we were calling for 1 or 2.
So want to back out for a moment because coming into this year, there was a lot of investors saying America first. And you saw the broader market really reflect that trade. That has changed. You have seen a lot of money flow into international markets. Carlyle is a global investor. Is American exceptionalism at risk?
I wouldn't bet against America. You know, if you go back to the 90s, when in the mid-90s, the European Union and the United States had the same GDP. Here we are 25, 30 years later, we have $10 trillion more of a GDP. There's a lot of fundamental reasons for why that occurred. We don't need to go through them. I think that as a global firm, we see opportunities in lots of places. So we have taken in the past several months 3 companies public. Standard Aero in the United States. We just 2 weeks ago took Hexaware public in India. It's the largest private equity-owned company to ever go public in India. We took a company called Rigaku, which is an X-ray technical company in Japan public. It's the largest ever private-owned equity company in Japan. All of this in the past 6 months. And our portfolios have gone up $5 billion in value, and we've returned a lot of value to clients. I would say that, is it surprising that after the S&P was up 50% plus in 2 years and the rest of the world had lagged, that there's been more capital moving overseas? No, I do think that if you're going to have a European Union that's going to be very focused on, for example, defense, which is not a surprise to us. We've had an aerospace defense practice for a very long time. On the heels of all the global conflict, defense is going to be a sector that's going to grow secularly again for a very long period of time. Regardless of tariffs, it doesn't matter. And so in a period where you go from geopolitical and globalization to less globalization, you're going to have increased spending on defense. So you're going to see defense stocks go up in the U.S. I think it all seems quite rational to me. But no, I wouldn't bet against America.
So I want to shift gears a bit now, because there is this dynamic going on in the markets where you have, of course, the public markets, and then you have the private markets, which, of course, you operate well, and you've kind of operated many times through both throughout your career. So in the mid-1990s, there were more than 7,000 companies. Now there are less than half of that. Many people talk about that being the dynamic of the situation we're in. Nobody talks about what the implications are. If you have such a vast private market, what do you do with that? How do you get more investors access to that?
So you nailed it. I mean, if you went back 20 plus years, there were twice as many public companies. I think there were 8 times as many public companies if you went back even farther, and there's 2.5 times as many private companies. And the private capital formation has been a trend that has been incredibly persistent for lots of very meaningful reasons. And it's secular, it's not going to change. Any prediction in terms of the sustainability and durability of private capital suggests it's going to keep compounding at 10%. So it'll be a, $25, $26 trillion market before we blink in terms of private capital. Now, what's happening is there are a lot of forces in the system that are driving more capital to private markets, demand from insurance clients as they look for private investment grade. And of course, the biggest factor is, and a lot of you are involved in this business, is what's happening in wealth. And really, if you look at whether it's 1%, 2%, 3% of portfolios in wealth individuals' portfolios today managed by people in this room, then if that grows to 5%, 6%, 7%, we're talking about an enormous trend. And I think the stats on U.S. pensions, for example, 40% are in alternatives. Ultimately, retirement accounts will be in private capital. It's the perfect balance of liability and return, and it gives investors diversification. So
401ks?
Ultimately, yes, for sure. Pace of which, hard to predict. But the wealth transition to private capital, for sure, is a durable transition, should be. The asset class makes a lot of sense for a lot of people. Advisors, I've spent a lot of time with advisors in the past 2 years. So Carlyle has been in that part of the business for a long time, but it wasn't strategically important as an initiative. When I showed up, we switched all that. We reorganized the team. It's one of our fastest growing areas. But this is, again, we've scratched the surface globally on wealthy individuals participating in these markets, so that capital stream will continue to come in.
How do you think about what might need to change about the industry in order to make this more available to wealth clients as opposed to institutional clients who have been able to get into a private fund, hold it for a very, very long time? Now you have investors borrowing their 401k that might want more liquidity. And do you think that that presents another set of risks too, a mismatch perhaps?
So I think the only thing that gets in the way of the industry and the growth of this is the industry. So if we execute at Carlyle, we don't want to rush. This is all about performance. If we say we're going to do it, we have to do it. And we have to understand the ultimate wealth client who's managed by an advisor or an RIA or one of the big platform partners that we work with. That is our obligation. And as long as we deliver the performance consistently over a period of time, with all the risk factors understood, then we will be successful and the industry will be successful. The only thing that worries me sometimes is there's a bit of an arms race, it seems, to develop solutions. There's clearly competition on the advisor side. Carlyle, I'm super fortunate that I had the opportunity 2 years ago. It's a really iconic name in finance. It's been around for, well over 35 years. To be successful in this industry, particularly this segment, you need global brand recognition. Carlyle's well known. We have wealth partnerships in the Middle East, in Korea, in Japan. We tend to think in a very U.S.-centric way that the wealth phenomenon is a U.S.-centric phenomenon. It's a global phenomenon. And that's why I feel confident in saying over the next 5-10 years, you'll see this trajectory of growth.
So we talk about private markets like it's a monolith.
All right, that was listening to Harvey Schwartz, CEO of Carlyle Group, with Sonali Basak talking about the private equity, private credit business. And we got a lot more coming from this Bloomberg Invest 2025. We're downtown World Financial Center. A lot more to come coming up in just a moment. We're going to check in with Robert Rubin, Senior Counselor, Centerview Partners, 70th U.S. Secretary of the Treasury. But in my memory, he is an elite Goldman Sachs banker among all the elites there. Right now, let's go to Charlie Pellet. Get a Bloomberg Business Flash, Charlie.
Thank you very much, Paul Sweeney. And here's what's going on. Fast-moving markets to the downside. Tariff Tuesday, the Dow, the S&P, NASDAQ, all in the red. And we are brought to you by Oracle. Attention, growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Stocks are getting hammered across the board. Lows of the morning as concerns about the impacts of a trade war on the global economy spur a fight to short-term bonds, gold, and haven currencies. The S&P is now down 107, down 1.8% at 5743. Dow Industrials down 702 now. That is a decline of 1.6%. The NASDAQ Composite Index down 351. NASDAQ now lower by 1.9%. The Russell 2000 Index of small cap shares down 2.4%. Bottom line here, equity market sell-off. The 10-year, 4.11%. The 2-year, 3.86%. Gold up $13 the ounce, $29.06, up by 0.5%. West Texas Intermediate crude down 1.7%, $67.25 a barrel. And Brent right around $70. Did dip below that number, right now down by 2.1%. Bitcoin plunging 4%, 81,900 on Bitcoin. Sources tell Bloomberg Sycamore Partners is nearing an acquisition of Walgreens Boots Alliance in a deal that could end the drugstore operator's tumultuous run as a public company. And Honeywell International is paying $2.16 billion in cash to purchase Sundyne. That is the maker of pumps and compressors owned by private equity firm Warburg Pincus. Again, recapping, U.S. stocks lower, S&P down 1.8%. Back we go to the Bloomberg Invest Conference. Once again, your hosts, Paul Sweeney and Alex Steele.
Charlie Pellet, thank you so much. We appreciate that. Charlie Pellet with the Bloomberg Business Flash here. We are at the Bloomberg Invest Conference 2025. We're down there in Lower Manhattan, World Financial Center, now known as Brookfield Place. A lot of smart people at this conference giving us the latest thoughts on what's going on in the world of global finance, including our next guest, Robert Rubin, Senior Counselor at Centerview Partners, 70th U.S. Secretary of the Treasury. and also former senior partner at Goldman Sachs. Bob, thanks so much for joining us here. There's a million topics we could go with you, but for better or worse, Bob, I think today is going to be known as Tariff Tuesday. When the tariffs hit, financial markets are really waking up over the last several days and weeks about what this could mean for our economy in terms of growth, in terms of inflation. How do you think about tariffs in general, and maybe how they're being used by this administration?
Yeah, I think tariffs are exactly what you just said. I think they create a very serious risk of inflation, not only because prices of imported goods will be higher, but domestic producers will be able to raise prices because their competitors' prices will be higher. But also, I think it's a substantial threat to growth because it can adversely affect productivity, since you can no longer have access to whatever is the most efficient producer of goods and services. And as you can see from today's papers, there's a very serious risk of retaliation. You know, more broadly, though, and that's a serious set of risks.
Right.
More broadly, I think there's the risk of a trade war. Mm-hmm. And trade war could be tremendously against our... This whole thing is against our self-interest. And there's one more aspect to it, though, that unfortunately has not gotten much focus, but should. We have treaty agreements with Canada and Mexico. We are now violating our commitments, our treaties. And what is that going to do to our credibility around the world? Not only with respect to economic issues, but geopolitical interests. This is massively against our self-interest.
At the heart of what the Trump administration is trying to do economically is pivot from fiscally funded economy to a privately funded economy, right? At the heart.
No.
You don't think that's true?
I have no idea what they're trying to do.
There is an argument to be made.
I'm not sure they know what they're trying to do.
But there's an argument to be made that that's what they prefer, right? Less fiscal stimulus and more private investment, and that's why they're trying to get...
No, but wait a second. You say less fiscal stimulus.
Yes.
Assuming that they get what they want in the reconciliation bill, that is to say, they get these large additional tax, or the continuation of the tax cuts, which would otherwise expire this year, that will substantially increase our deficits. The projections are that independently of them, deficit's going to continue to go up substantially, and with them, even more so. So I would say they're on a fiscally irresponsible and I think very dangerous path. Although that's a continuation of conditions that have been. They're simply making them worse.
So you mentioned the debt, annual deficits. I've been on Wall Street since 1986. That's been a story since 1986. It's probably well before that. Is there a scenario where we really have to pay attention to these deficits?
I think we've been at that point for quite some time.
Okay.
But we're in new territory now. Roughly speaking, we're at historic highs in terms of the debt-GDP ratio. The CBO projects that they're going to go from the current 100% to about 120% 10 years from now. But that independent analysts, by looking at increased or likely increases in defense and interest costs, rather, et cetera, think 130 to 135% is more likely. I think it is enormously dangerous, and the policies of this administration, at least as currently projected, are going to make that worse.
So how do we fix it? I mean, Ray Dalio said yesterday the debt crisis in 3 years could look like a heart attack.
Yeah, I saw Ray's comments. Yeah. I'm not sure exactly where he gets that from, but anyway. But I think, sort of conceptually, at least, he's right. With a heart attack, I'm not sure I would use that analogy. I'll tell you what I think is more likely than Ray's. Well, Ray is a very perceptive and astute observer. No, I think more likely is you'll have a higher interest rate, you'll have reduced business confidence, you'll have fewer resources for public investment and national security. That will happen over time. The risk is that at some point it becomes what Ray just said, which is a fiscal crisis. The problem is, to deal with this, we can cut some expenses, but there's not that much to be cut. As a practical matter, it's very limited. What you predominantly need are more revenues, and the politics of that are terrible. This administration says the tariffs will give them more revenues. Two problems there. One is the tariffs will provide revenues, but at the same time they're going to adversely affect growth most likely. And if you look at models, and I have looked at models of this, the net effect is very small. And secondly, it is highly adverse with respect to growth and inflation. And as I said a moment ago, it means a violation, or that's what we're doing, a violation of treaty obligations, which then can affect our credibility around the world, which can affect us both geopolitically and economically.
Another pillar of this administration is immigration, handle on immigration legal, maybe a stronger handle on immigration legal and illegal, maybe even deporting some workers back. A lot of economists will say, well, that's not good for the economy either, because these folks are working, they're paying their Social Security taxes, they're doing jobs that Americans don't want to do. It's actually additive to the economy and keeping inflation down from wage inflation. How does that play into it? How do you view
I think
that?
you got it exactly right. If you look at the numbers over the last few years and you look at the growth we've had, which has been very good growth, some fair portion of that is because of immigration and the increase in the labor force. Furthermore, we've been having, on the legal immigration side, people of all skill levels, and a lot of very, very highly skilled people have come into, particularly tech, but also across our economy. The illegal immigrants are a more complicated question, but I think what you need to do is you need to approach that not from an ideological perspective, which I think is what's happening, but rather from an economic perspective and decide what, from a cost-benefit perspective, is in our self-interest. And the answer to that is going to be, I think at least, a substantial increase, well, increase may be the wrong word, but a robust policy with respect to legal immigration, and then an approach to those who are illegals who are here that is based on the economic effects of what we do.
I am judging myself for asking you this question, but I feel like I have to because this is what people are actually talking about in terms of Trump policy, and that's the Mar-a-Lago Accord idea that potentially you'll see, a big deal among major economies to address the exchange rate and trade imbalances. So you can have a trade war and not have a stronger dollar, etc. Is anything like that something that you are listening to, talking about, like a Plaza Accord a la decades ago?
Well, a Plaza Accord was in a very different set of circumstances. I'm not sure what they're driving at, but whatever it is, I don't think they're going to get there this way. Aside from which, I think there's a lot of ideology about all of this. If you have trade deficits, and what's happening is you have an influx of capital, and then it goes into investment, that actually improves growth in the United States and is good for us. Mm-hmm. Now, if it goes into consumption, then eventually you build up, and if it goes into investment, then you have additional growth and you can pay back the debt. If it goes into consumption, then you don't have the growth and you don't be able to pay back, and over time that creates a problem. But whatever you want to do, you do not want to approach it through tariffs, and you don't want to approach it through browbeating other countries or taking advantage of what is a strong position of our economy. What you want to do is want to increase productivity in this country and increase savings.
AI, you told us offline that you've been really spending a lot of time trying to get educated on AI. We've got a full minute here. What do you think about AI?
No, I'll give you my views.
Okay.
About a year and a half ago, I thought to myself, AI looks to me like it's going to be really important. So about a year and a half ago, I started taking a tutorial. I go twice a week, an hour each time, and I don't profess any expertise in it, but I think I've become reasonably conversant with it. And I think it's going to change life as we know it, economically, geopolitically, and societally. And I think I don't think we're at all ready for all of the effects it can have.
What's an AI tutorial? Like what is it some guy at your desk going over stuff with you?
No, I'll tell you what it is. It's an extremely bright guy. We do it on Zoom, and he's taken me through the underpinnings. How does it work? And then what are the use cases? What effects does it have? And the more you get in, I would strongly recommend reading a book that's been recently published by Eric Schmidt and Henry Kissinger. And what they do is they go through what AI, what it is, but basically go through the ramifications, the potential effects of AI. It is really enormously worth reading. This is going to change, in my opinion at least, have profound effects on pretty much everything we do over time.
Yep, that's what we're hearing from a lot of smart people as well. Robert Rubin, thank you so much for joining us. Really appreciate it. Robert Rubin, he's a senior counselor, Centerview Partners, 70th U.S. Secretary of Treasury, and of course, former senior partner at Goldman Sachs. We appreciate getting some of his time talking about some of these markets, and we're rolling over here. I'm just letting you know. The S&P 500 is off about 1.4%. The NASDAQ's off about 1.4% as well. The Dow, just to quote big numbers because we all grew up with the Dow, off 600 points. That's around 600 points off 1.4%. Yields coming in, 10-year Treasury yield. Boy, I can get that at 4.13% here. WTI crude oil for Alex off 1.3%, $67 per barrel. We'll have more coming up from the Bloomberg Invest Conference. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks lower across the board on concerns about the impact of a trade war on the global economy, with the Dow, the S&P, and NASDAQ all lower by 1.5% or more. S&P right now down 93 at 57.56. That is a drop of 1.6%. Dow Jones Industrial Average down 665, down 1.5%. NASDAQ down 286, a decline of 1.6%. 10-year 4.13%, the 2-year 3.87%. Gold up $16 the ounce, $29.09 right now, up 0.6%. West Texas Intermediate crude down 1.4%, $67.43 a barrel, and Bitcoin now down 3.2%, 82,577 on Bitcoin. Ford shares down 2%, General Motors down 3.6%. Auto stocks lower on the imposition of tariffs on Canada and Mexico. John Murphy is an equity analyst with BofA Securities.
We've got to run through this. I mean, Ford is 15 to 20% of their production is in Canada and Mexico. GM is closer to 25 to 30%. You could say Nissan and Mazda would be the most impacted because they have heavy exposure, or most of their production is in Mexico for the North American market.
Again, Ford down 2%, GM down now by 3.5%. Yesterday, you recall, Bloomberg News reported that tariffs on Canada and Mexico risk driving up U.S. car prices by as much as $12,000. Recapping, S&P now lower by 1.5%, the 10-year 4.14%. Back we go to the Bloomberg Invest Conference. Once again, your hosts, Alex Steele and Paul Sweeney.
All right, thanks so much, Charlie Pellet, Alex Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from the New York Financial District with the Bloomberg Invest Conference 2025, bringing together financial leaders, asset managers, private wealth, private equity, as well as banking together to talk about the main issues of our time. And we have one of them here right with us. Mark Mahaney is Senior Managing Director at Evercore ISI. Perfect day to talk to you. NASDAQ 100 now below its 200-day moving average. The pressure not abating. What is in particular leading the tech part of the sell-off?
Maybe two things. One is that it's a sector with that's had phenomenal outperformance for the last 2.5 years. So in a reversion to the mean trade, you revert down the stocks that have outperformed the most. That's true. They've had phenomenal performance since the middle of 22, since interest rates stopped spiking. And then the second thing is, when the tariff issues, these are all, especially the tech leaders, are dramatically global companies. Half of their revenue or more comes from overseas. Amazon has doing a lot of retail, obviously, from China, but through Mexico and Canada. So anything sort of tariff issues would upend their business somewhat, depending on how well hedged they are, just as it would for any major retailer. So I think those two issues coming together are what's derailing those stocks right now.
Mark, you've been covering the tech sector for a long time. You were there at the beginning of the internet. A lot of people are comparing AI to the internet in terms of the ability to transform many aspects of life. How do you package that AI story for your clients these days?
I don't know if it will be that transformative, but the amount of money that's going into them, paid by companies, put in by companies that have plenty of cash, is something of a tell. And then we've seen a lot of examples of what I call ROAI, ROI, return on investment, ROAI. So, we're staring at it right now. Look at what's happened at Meta in the last 2.5 years, how they've turned around their business, and and they've dramatically improved their services for customers. That's you and me as consumers. Our news feed has become more relevant because they've used AI to do better targeting, better recommendations, but also for advertisers. The return on ad spend, ROAS, has risen because the campaigns have become better targeted, better better managed. So I've seen a couple of really great ROAI examples, and so I'm not sure it's transformative, but it's definitely improving the performance of these companies, and it shows up in the P&L too. I think you can also look at Google. 25% of their code is now written by AI. Imagine the productivity improvement associated with that. And then Amazon is talking about 25% lower cost to serve in its most advanced distribution centers. I mean, that's why their margins are going to continue to go up. So you're seeing it in the P&L. So I think it's actually a major productivity improvement, and I think this is going to play out for years.
Okay.
We do have some breaking news for you. This, according to the Wall Street Journal, that Ontario is going to issue a 25% export tax on electricity to the U.S. Canada, in particular, not only does it have oil, it has a lot of hydropower.
Yep.
So they're going to be taxing electricity
go.
to the U.S. Here we go. Okay, so back to AI and the transformative part of it and how it's going to trickle out through the economy. When do you think we're going to really understand how inferencing is going to impact us and companies? And, like, when are you going to get me to buy in to an AI story?
Well, I tried to lay out a couple of examples already of where these companies are deploying AI and machine learning, and they have been for quite some time. We've just had a step up, like a hockey stick improvement. You just mentioned Canada, hockey stick inflection up in productivity gains because with these companies. So I'm sorry, I think we're already starting to see it, and I think we're seeing it in.
But do I see it? I mean, maybe my news feed, but will I pay for it?
Well, you want some really specific product examples? I got a really fun one for you.
Okay, into it.
You want to learn languages? There's this wonderful app called Duolingo. You want to really learn a language? Pay up for Duolingo Max, where you can use an AI-generated bot to actually practice your French, your Spanish, your German, your Russian, whatever we need to learn these days. Anyway, and I think you're going to see more of these kind of little one-off examples. But from a company's perspective, anything that produces internal productivity, improves relations with suppliers or customers. I mean, all of that's. I don't think there's one. I don't think there's one AI revenue build, but you'll see a couple of products that wouldn't exist. And I think Duolingo example is one that simply wouldn't exist if you didn't have AI.
How about for Google and the traditional search business? Is AI a threat to Google or not?
Google just put out a blog that said that because of AI overviews, that they're actually seeing more commercial search queries.
Really?
That should raise all of our eyes. So, and I guess I'm not, at the end of the day, not surprised. Google is a company that just consistently improved the product, made the search results faster and faster and more relevant. This just took that up a notch. And so, yeah, if they can get you the result you want more quickly, and especially if it's leading to more commercial searches, Google is the one company in the world that knows how to monetize commercial searches.
What do you think is the biggest misconception about AI, whether it's like what investors think, what's priced into the stock, or just conceptually?
I think the biggest misconception probably occurred about 3 weeks ago when DeepSeek came out, and there was concern that this would be highly disruptive for the hyperscalers. I actually took the exact opposite view, especially if you're at the application layer, because the infrastructure potentially just got a lot cheaper. So you're going to, all that money that you've spent on CapEx, you're going to get a better return. That money wasn't wasted. You're going to get a better return than you would have had in the past. So I think that's probably the biggest recent misconception I've seen.
For Meta, it's had a great turnaround, as you talked about. What percentage of that turnaround is simply cost cutting versus maybe just stepping away from the metaverse discussion somewhat?
I think it's two or three things. Stepping away from metaverse, focusing on the year of efficiency that Zuckerberg talked about at the beginning of 23, and now it's become the years of efficiency. And I think this does tie back into the AI. I mean, there has been a mind shift in Silicon Valley. It's not growth at all costs. There's much more of a focus on, so there's a cultural shift that I think is probably good. These companies are going through their middle life stages, not crisis, but stages. And as they do that, they should be spending much less aggressively on growth. They should be focused more on profitability than they are. But then the tie into AI is their developers can produce more code with fewer developers. It's not like they need to cut people from this point on, but they can grow. They can sustain growth with less need to add headcount than they did in the past.
All right, Mark, such a pleasure. Really, really great to see you in
Alex.
person. Thank you, Mark Mahaney, Senior Managing Director over at Evercore ISI. I just want to hit back on that headline, Wall Street Journal reporting that Ontario will issue a 25% export tax on electricity to the U.S. Another headline here that Ontario is going to be removing U.S. products now from liquor stores.
Oh, boy.
There we go. So much more coming up here from Bloomberg Invest. In particular, we're going to take a panel with Dawn Fitzpatrick. She's a CEO and Chief Investment Officer at Soros Fund Management. Plus, Jonathan Gray, President and COO of Blackstone. We will take all of that live from this Bloomberg Invest Conference on a day where markets are really tumbling here. We are right around that lows of the session. You have the NASDAQ off by about 1.3%, the S&P off by 1.5%. This is Bloomberg. Happy Tuesday.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Paul Sweeney, Alex Steele. We are at Bloomberg's Invest Conference 2025 right down here in Lower Manhattan in the heart of the financial district. We want to take you now to a live panel with Bloomberg's Eric Schatzker and Don Fitzpatrick, the CEO and Chief Investment Officer of the Soros Fund Management.
Job as Chief Investment Officer. He worked at Soros in the 1990s under George, of course, and also under Stan Druckenmiller, and he returned as the CIO in 2011. You arrived in 2017, a couple of years after he left, right?
I arrived about a year after he left.
I bring this up not just to establish a distinguished lineage, but because it serves as a useful reminder that Scott Bessent has to be, right, the most market literate and market savvy Treasury Secretary since at least Bob Rubin and perhaps in American history. Now we have a president whom we know thinks of the stock market as a daily report card, and a Treasury Secretary who's laser focused on macro indicators. Why is that important?
So a couple things. Scott is incredibly smart. He's capable, and I think he is the most market savvy Treasury Secretary we've ever had. I think it matters because when he says something, you should take him literally. So he has said he and Trump care about the level of 10-year treasuries. And I think he will pay very close attention. In a kind of perverse way, right after the election, we had the Trump bump, and as Eric pointed out, we've had something different in the past week or so, and you've seen that 10-year Treasury go from 480 in the middle of January, where they were getting nervous, and if you remember, they kind of backed off some of the tariff timing at that moment in time. Now you have a 10-year Treasury that's down at the 412 level, and I think they should be getting a little nervous. I think the one thing that market participants maybe have underestimated, in the first term we all said Trump is very SPX sensitive, and that was invariably the truth. I think with Scott, I think their pain tolerance is different, and I think they're more sensitive to a broader set of asset classes, and I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said it today, manufacturers will absorb the price pressure, and then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence, and I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
So I would take the other side of that bet, because again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit, and I think they will make deals.
There's a view in the market that Scott's preoccupation with keeping the 10-year yield low foreshadows a coming change in bank regulation. You know, if the administration wants to juice demand for treasuries, it could exempt treasuries from the supplementary leverage ratio, one of the capital penalties that the big U.S. banks have to pay. Do you think they'll go there?
So I definitively think that is going to happen. So when you look at kind of the net issuance of treasuries post-COVID, it's almost all been bought by the levered hedge fund community. And I don't think, first of all, that's not a sustainable kind of marginal buyer. And it also probably isn't good for market structure and market stability. And when you look at what came out of Congress last week, you know, the deficit is not going lower in any material way. So what I think they're going to do is they will change bank regulation and the supplemental leverage ratio, allowing banks to buy treasuries in ways that won't be regulatorily punitive. And the next step is they will try to take some leverage out of kind of that basis trade and the levered market. And again, I think this is where Scott understands the moving parts in ways that I think will ultimately be really helpful.
You've given us a couple of clues about how you might be trading the bond market. You take the other side of 3 rate cuts this year, but at the same time, you think that the administration will be inclined to help lift demand for treasuries. How are you trading treasuries? Like, what would you buy and where? And are you a holder or are you a seller at any point?
So we are a reasonably large holder of U.S. government bonds, but we're below our benchmark weight by a little bit. And what we've been doing is we've been using volatility as our friend. So in January, when the 10-year rate spiked, we were buyers of bonds at that time. And then now, as you've seen kind of rates go lower, bonds rally a lot, we're not taking profits. And you'll see us continue to build a position into that volatility. And I think you're going to see continued volatility. Again, this moment in time, rates are going lower, but I don't think that's going to be true for the next 4 years.
Volatility can be your friend. Is that? I guess I better put it this way. What's the best thing and what's the worst thing about trying to put money to work in this market?
Yeah, we're technically we're an endowment, but we use the best of the endowment model and the hedge fund model, so we can react very quickly. And I think we're very good. I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
Yeah, that's a good question. So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the US and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the US. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market. Again, for us, that's more of a short-term tactical trade than a longer-term position.
I feel like I have to ask you the requisite Mag 7 question. Those stocks are down about 13% or so from the peak in December. That was as of yesterday. I didn't check this morning. Probably down by more. Tesla's off, what, 40? NVIDIA's lost 24%. Are those buying opportunities?
Yeah, so I think the Mag 7 are, I mean, those are extraordinary companies with real earnings power, and the unwind here has been pretty violent. So I would take the other side of that trade.
And of course, we are witnessing some historic shifts in U.S. foreign policy. It would appear that the United States is to a degree abandoning Europe, perhaps embracing Russia and Vladimir Putin. Has that translated? Will it translate into great macro trades?
Yeah, so, Russia's not that relevant from a trading perspective. When they invaded Ukraine, it didn't really reverberate through markets. And I think in the context of what's going on now, the only thing that's worth watching, in my opinion, in the context of trading markets, is oil. And whether ultimately, and this is a big if Trump can negotiate a peace between Russia and Ukraine, whether part of that deal is, Trump needs more oil, right? Part of what he's been promising the US consumer is lower prices, and particularly lower prices when it comes to the gas pump. The US really can't drill more. It's not in Saudi Arabia's best interest to produce a lot more. They need about $90 a barrel to balance their budget. So the lever he can really pull there is Russia. And one kind of wild card would be Russia dropping out of OPEC. And that would have a real impact on oil price in the context of moving it lower.
What about America ripping the security blanket away from Europe? I could imagine that we've already seen, right, the Germans move toward spending. In fact, I think they found some flexibility this morning, right? 200 billion euros on additional 200 billion on defense. And we hear the same noises out of France. Surely that has to, result in at least some bond issuance.
Yeah, so if you look at Europe and if they end up spending the 2.5%, to 3% of GDP on defense, that's $175 billion a year. And when you think about the fiscal space they need just generally, the amount of bond issuance out of the EU and European sovereigns is going very materially higher. At the same time, when US net issuance is also going higher. So I think one of the things that we might see, and this isn't going to happen tomorrow, but I think it could happen in the next 12 to 24 months, is a failed auction out of Europe. I just think at some point, sourcing that marginal buyer is going to become extremely difficult.
Do you feel confident enough to predict which country will fail to sell enough bonds?
The two most vulnerable countries are the UK and France, in my opinion.
Don, there's a lot of Western money, including some of yours, trapped in bets on Chinese private companies. ByteDance, of course, tops the list, but there are lots of others. Could that logjam maybe start to break if Presidents Trump and Xi negotiate some kind of a deal, whether it concerns trade or whether it goes even beyond trade?
So I think there's a lot of people hoping for that, and as Eric said, us included, where we have private capital in China, and we've been, everyone thought these companies would come public years ago, and the markets just didn't allow for that. And if you remember, the Chinese government kind of closed that door at the 18th hour. So if there is a tactical deal between the U.S. and China, I think there's a lot of market participants, us included, that will hope that the private to public markets unfreeze and we can get some money out. I think if you get money out of privates, it's only going to be in that very, very tight top tier, like a ByteDance. And to be clear, ByteDance is probably the most largely held private company by real asset investors in the world. So there's a lot of people with that hope trade on.
This feels like a good time for us to wade into the public-private debate for a moment. Because for years, right, foundations like yours and endowments and pension funds and sovereigns have been plowing money into private equity. Of course, they've had some trouble getting that money out of private equity over the past couple of years. And now private credit is the rage. And more capital, as a result, is flowing into illiquid vehicles. Why do you believe in liquidity when everyone else, right, from Apollo to BlackRock, is extolling the virtues and the benefits of private markets?
Yeah, so over the last, again, we typically are benchmarked against the typical largest U.S. endowments, but over the last 6 years, we actually let our private equity positions roll off. We still allocate it to the best managers, but with a really high bar. So we lost about 1,000 basis points of exposure there, which, to be clear, has served us really well. And at the same time, we pivoted to public markets. And it's interesting. I think a lot of both high net worth and institutional investors pivoted to private markets in part because you didn't get a scorecard every day, and your Sharpe ratio and the returns looked artificially good. And by doing that, first of all, I think those investors are in a world of hurt right now, both in context of liquidity and in the context of they've massively lagged a equity market that has until the last couple of weeks been on fire. But the other thing is, if you're Soros Fund Management and you have a long-term perspective in public markets, you have a lot less competition because it's most of the active money is large multi-strat investors. So for us, the capital allocated to public markets above our benchmark, we've annualized 650 basis points of excess return over the last 5 years. And I think it's because we play our own game.
What does that mean in actual numbers? 650 over what last year? 650 over what in 2023?
So it's always our beta benchmark is MSCI ACWI, and then we have the risk-free rate. So we don't give ourselves any credit for what you can get, by in money markets or what you can get by buying beta, and we assume we're at our benchmark weight in those. So add those together and then add 650 basis points. By the way, the thing that's pretty interesting is when you look at the last 2 years, your private equity has lagged by more than that. So you needed that active return in public markets to make up for the sins in private equity. But we think our peer endowments and foundations haven't had that offset.
So you're thinking more along the lines of a hedge fund. Tell us what you returned in 24, what are you year to date, and And when you look at those numbers, do you think of your competition as Citadel, or do you think of your competition as the Ford Foundation?
So we think of both. Like, we want to be clear, we want to take the best from both of those operators, but we don't play Citadel's game. There is no one. Citadel plays the multi-strat game, and nobody plays it better than them. And I think the distance between Citadel and their competition has only grown. And again, relative to other foundations and endowments, there are some things they do really well, and we like to take those pieces. But again, play our own game and play a game that we think no one else in the world can do quite the way we do it.
Dawn, on behalf of everyone here, thank you very much for joining us here at Bloomberg Invest.
Thank you.
You've been listening to Dawn Fitzpatrick of the Soros Fund Management, along with Eric Schatzker of Bloomberg, talking through a lot of the issues in the market. More interestingly, talking about liquidity and really wanting that liquidity versus private equity. Really interesting words. You don't necessarily hear that right now in the market. So interested in that. We're going to talk to Mark Lipschultz, Blue Owl Capital Co-CEO later. That's private credit, but still quite interesting. Let's get you caught up on the markets here as we continue to trade right around the lows of the session. Here is Charlie Pellet with the Bloomberg Business Flash.
All right, I thank you very much, Alex Steele. Indeed, as you mentioned, very close to session lows right now. Right to the numbers here. We got fast-moving markets. Tariff Tuesday, that is the big story, with the Dow now down by 777 points, a decline of 1.8%. S&P, as I mentioned, just at session lows now, down 107, decline there of 1.8%. NASDAQ lower by 310 points, a decline of 1.7%. We got the 10-year at 4.12%, the 2-year 3.86%. Spot gold trading higher by $14 the ounce, $29.07 right now, up 0.5%. West Texas Intermediate crude 67.23 a barrel, down 1.7%, and Bitcoin now lower by 3.1%. Bitcoin at 82,632. This Bloomberg Business Flash is brought to you by Oracle. Attention, growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in Lower Manhattan at the Bloomberg Invest 2025 conference. Lots of panels we're going to dip into throughout the day. Right now, let's go to a press conference held by Canada's Justin Trudeau. Let's take a listen on tariffs.
We responded to concerns, including from the president, by implementing an ambitious $1.3 billion border plan. A border plan that includes generational investments in new AI and imaging tools to stop the flow of fentanyl in its tracks, stronger coordination and information sharing with American agencies, along with the deployment of drones, helicopters, and additional personnel to keep our border secure. Now, a month ago, as part of an agreement with the United States that paused the tariffs, we made further commitments. We appointed Kevin Brasseau as our fentanyl czar, a man who dedicated his multi-decade career in law enforcement to combating organized crime networks and drug trafficking. We designated 7 drug cartels, sick, evil groups who cynically profit off the pain and suffering of people on both sides of the border, as the terrorist organizations that they are. And just yesterday, we launched a new joint operations partnership supported by a $200 million investment between Canada's security and law enforcement agencies, a partnership that will enhance the coordination of information and intelligence in order to thwart criminal gangs involved in the illegal fentanyl trade. And critically, our actions are working. As the U.S. Customs and Border Protection just acknowledged, there was a 97% drop in fentanyl seizures from January compared to December, to a near zero low of less than half an ounce seized in January, even with all the further enforcements and actions we've taken at the borders. In some, we stepped up. We engaged closely and constructively with the president and his administration. We did everything we promised. We stuck to our word. And we did it because we believe in working together to protect our citizens. Now I want to speak directly to one specific American, Donald. In the over 8 years you and I have worked together, we've done big things. We signed a historic deal that has created record jobs and growth in both of our countries. We've done big things together on the world stage, as Canada and the US have done together for decades, for generations. And now we should be working together to ensure even greater prosperity for North Americans in a very uncertain and challenging world. Now, it's not in my habit to agree with the Wall Street Journal, but Donald, they point out that even though you're a very smart guy, this is a very dumb thing to do. We two friends fighting is exactly what our opponents around the world want to see. And now, to my fellow Canadians, I won't sugarcoat it. This is going to be tough, even though we're all going to pull together, because that's what we do. We will use every tool at our disposal so Canadian workers and businesses can weather this storm. From expanding EI benefits and making them more flexible to providing direct supports to businesses, we will be there as needed to help. But Canada, make no mistake, no matter how long this lasts, no matter what the cost, the federal government and other orders of government will be there for you. We will defend Canadian jobs. We will take measures to prevent predatory behavior that threatens Canadian companies because of the impacts of this trade war, leaving them open to takeovers. We will relentlessly fight to protect our economy. We will stand up for Canadians every single second of every single day because this country is worth fighting for. Les derniers mois ont été stressants.
That was Canadian Prime Minister Justin Trudeau talking about some of the their willingness to work together with the U.S., but concerned obviously about the implementation of those tariffs, and we're seeing some retaliatory tariffs coming fast and furious from Canada.
Yep, Justin Trudeau saying that Donald Trump is a smart guy, but this is a dumb thing to do, so distinguishing that, saying that President Trump's claims about Canada on fentanyl are false, and that says that Canada is discussing, quote, non-tariff measures against the U.S. as well, and will expand support to businesses during this trade war. I want to get more on this with Enda Curran. He joins us from Washington, D.C. from Bloomberg News. Enda, is it fair to call this a full-fledged trade war at this point, or not yet?
I think that's pretty much the territory we seem to be in. You have tariffs going on between the world's two biggest economies, tit-for-tat tariffs, and of course among the US's biggest trading partners, Canada and Mexico. And the interesting thing about these tariffs on China is that they are across the board. They're not selective, they're not targeted, they're not national security related. It's across the gambit of goods that comes out of China into the US. And likewise, when you look at the goods that come out of Mexico into the US, you're talking about apparel, you're talking about beverages, you're talking about food, you know, squash, peppers, avocados, 25% going on top of all that. And the Canadian side, you've got your lumber and steel and the automotive components and the like. So take it all together, and with the retaliatory responses, this is a significant escalation of the trade war for sure.
And earlier this morning, Alex Steele and I were speaking with Robert Rubin, thank you, from former Secretary of the Treasury and from Goldman Sachs. He basically echoing that this, from his perspective, is just bad policy all the way around. Who has the president's ear to the extent that the president is proceeding so aggressively on this tariff policy?
Yeah, I think I think that's right. I think, broadly speaking, the president has moved faster than expected on the trade policies. I mean, there had been a view that A, tariffs were mostly going to be a leverage or a negotiating tool. B, practically speaking, his team, his Commerce Secretary and his trade representative hadn't really been confirmed until recently. But nonetheless, we've travelled a lot of ground in these 6 weeks. And I think the question a lot of economists were asking this morning when I was going through the reaction is, near term, these tariffs are clearly in negative for growth. They will drive up prices and they will cause disruption to business. But the question is, how long will they stay on? Is it some kind of a negotiating stroke leverage tool? To your point about this is a grand strategy, people around the president are steering him on this, or are these tariffs going to stay in place long term? And if so, the longer they stay on, the bigger the impact will be to growth. So I think that's one of the key talking points coming out of this morning. There is quite a lot of shock among economists. It's happened so quickly, but still question marks over how long are these tariffs going to stay in place.
But then there's the context, too. In particular, the headline earlier from the Journal that Ontario is now going to be taxing electricity to the U.S. I was talking to Rob Barnett of Bloomberg Intelligence, and he said that in 2024, the U.S. imported about 27 terawatt hours of power from Canada. That's less than 1% of U.S. power needs, right? So some of the headlines and the numbers look really big, but then when you look at the specifics, it may not be that much of a change. And how do you filter through that?
That's right. So when we're talking about the pain, most economic pain will be felt by Mexico and Canada. They're expected to even fall into recession. And obviously, there will be considerable pressure on China's exporters too, given you're talking about 20% tariffs now. So the U.S. is shielded to that extent. Nonetheless, though, there is a feeling that, and again, it goes back to the duration point, the longer these tariffs stay in place, then the more price pressures there will be in companies, the more pressure there will be to pass on those costs to consumers, from household goods right up to, the industrial components. So there is an inflation component part of this. And then the second round effect will be, well, if that's the case, how are people going to respond in terms of buying goods? How will consumption patterns adjust and change? Will people buy less? Will there be less investment by companies? And then you get into the growth round. So, to your point, there is a context in all of this. President Trump says it will drive investment, but there's also a case that economists are making that there will be near-term economic pain too.
All right, and thank you so much. We appreciate that. Ender Curran, economics reporter for Bloomberg News. He's based in Washington, D.C., giving us some color on these tariffs. Again, Canadian Prime Minister Justin Trudeau making some comments there about the trade situation. Right now, let's go down and check with Charlie Pell and get a Bloomberg Business Flash.
All right, thank you very much, Paul Sweeney. The Dow, the S&P, NASDAQ all declining by 1.5% or more. Right now, we have got the S&P down 102. That is a drop of 1.6%. The Dow is down 1.7%. Dow Industrials down another 744 points, while NASDAQ is lower by 285 on the NASDAQ Composite Index, a loss right now of 1.6%. The 10-year, 4.13%. The 2-year, 3.88%. We do have spot gold trading higher, up by $16 the ounce, $29.09, up by about 0.6%. And West Texas Intermediate crude, $67.50 a barrel. WTI down 1.3%. Brent right around 70.41 right now on Brent crude, down 1.6%. Cannot ignore the move in Bitcoin, dropping now by another 3%. Bitcoin at 82,757. So again, recapping, the Dow, the S&P, NASDAQ in the red, with the S&P down by 100 points. Tariff Tuesday, a drop right now of 1.7%. Back we go to the Bloomberg Invest Conference. Once again, your hosts, Paul Sweeney and Alex Steele.
All right, thanks so much, Charlie Pellet. We appreciate that. Paul Sweeney, Alex Steele here. Happy Tuesday. Tough tape if you're looking at the equity market. We are live from the Bloomberg Invest Conference 2025. We have all the top minds in finance talking about the pressing issues, not only how to invest money, but the future of some of the significant things and the transition that we're going through, like, for example, AI. And here joining us on set is Ben Wren. He's founder and CEO of SigTech. Now, SigTech is a London-based fintech company spun out of Brevan Howard in 2019, and it basically tries to help quants and users manage the capital markets. I'm not really sure I know what that means, so luckily Ben is here for us. All right, so give us the quick pitch on what your company actually does.
SigTech, we build specialist AI agents these days to help people make better decisions in capital markets, but also to automate a lot of the very high-value intellectual but not very creative workflows. We can reduce a lot of the things people do today, which are a bit boring, down from many hours to 30 seconds. I think that makes a big difference in terms of productivities.
All right, here's an example that I can think of from my
tell me.
Being at the printer, not far from here, a couple blocks from here, Don Lilly, at the 2-3 o'clock in the morning, going over a bond prospectus. That's probably something that AI can help with. So, Ben, how much are asset managers, generally speaking, how much are they using technology today? How computerized is it? How quantitative is it?
I think in the last 15 years, there's a big trend in asset management to adopt more and more technology. And we can see this shift in terms of people using more data-driven investment processes, and people hire data analysts. But Gen AI in the last few years is a big step change. I would say it's a unprecedented change in this trend. Just in terms of it's no longer incremental. There's a before and after. And when we think about previous technologies, we mainly focus on what we call explicit knowledge that we can codify, describe, and therefore use programming language to automate. But only until now, we are able to distill and automate so-called tacit knowledge, the knowledge that resides in our head, but we can't really so easily write it down and describe and codify. But now we can actually automate those, and there are plenty of those workflows and processes, especially in financial services.
So how would you help like a regular quant manager? Like I go to you and I'm like, hey, I need your product to help me get better, faster, find better trends in the market.
Yeah, for quants, I think quants started with more number-driven. Trend following is if you do it like in a very simple way, it's entirely number-driven. But these days, we are moving to a world where we have to deal with numbers and text as two modalities at the same time. It's no longer just about technical analysis, but it's also about absorbing new information and turn non-numerical information into numerical information. And that's something that Gen AI does really well. Because fundamentally, if you think about how it's trained, it has been trained on trillions of tokens of textual data. And a lot of things we used to do in a bespoke or proprietary fashion, these days we get out of box, such as sentiment analysis or extracting relevant information from very long pieces of text. These sort of things actually change how quants approach their daily jobs.
Are the big Wall Street firms making these investments, or is it more the hedge fund community that is more receptive? Who are your customers typically?
So these days we mainly focus on buy side.
Okay.
But we also have very big clients in terms of like commercial banks, using our technology to completely change how they underwrite commercial loans. I think so. I wouldn't say it's a sell side or buy side or big firm or small firm. I don't think that's the main reason in terms of adoption. I would say the main reason is the leadership. When you approach something so unprecedented, it takes some time to build a consensus inside your organization about what's the strategy, what do we do. But that may take 2 months, 3 months, and given how fast things change, after 3 months it's a different world.
Yeah.
Right. So it really takes some kind of conviction from a visionary leadership team to adopt this technology very confidently.
Yeah. After 24 hours, it can be a different investing landscape. So what's the best partnership between AI and humans? 50-50? Is it AI 75% of the decision-making process, 25% for human? How do you think about that?
Yeah. I think if I think about the knowledge work we do every day, I would describe them as most of them maybe not creative, but intellectual, right? Analyzing a lot of documents, picking out the right information. It's intellectual, but it's not creative. So in the future, humans should devote almost all their time to creative stuff, what makes us different. Whereas the boring intellectual stuff can be automated by AI agents. On the other hand, we are certainly seeing a big change in the user experience, the user interface, because up to until this point, people approach Gen AI mainly through a chatbot. there's a chat box, you type into it, you get some response. It's very nice, and it's really started the era. But going forward, we are looking at a user interface that allow a human to essentially collaborate with a large number of AI agents who specialize in different things. So how does that user interface look like? And how does that AI-human fusion intelligence look like? It's a very active field of research, trial and errors.
So this sounds like, from what I understand of AI, a lot of computing power requirements. Talk about the investments that you think these financial firms need to make, are making, or maybe need to step up.
Yeah. In terms of intelligence, the way I think about it is it's very similar to electricity.
Okay.
So we are currently in the first stage of investing in the infrastructure, right? And if you're going back in history, in the last 200 years, and then the way we started building electricity grid, there's one magical number, which is 1%. The countries throughout the history spend about 1% of nominal GDP on building power grid, from 200 years ago in Britain all the way to today. So the big tech this year announced $300 billion of investment into Gemini data centers. That's almost exactly 1% of the US GDP today. It's about 30 trillion. So in terms of infrastructure investment, we are there. And people are building incredibly big mega AI clusters across the country. Now, but we are shifting toward the application layer, right? Because once you have electricity, it's not about electricity per se, it's about what kind of appliances you can build powered by electricity. So we are moving into that stage too, where there are a lot of investment, both in terms of talent and capital, into building the right applications that can actually make a big difference to the knowledge workers in terms of productivity. So we are starting that phase.
Last question here for us. I asked this of Mark Mahaney too, is what's the biggest misconception right now when it comes to AI and using it?
I think the biggest conception is, I think people tend to either underappreciate its capabilities or sometimes getting over optimistic. I think it's quite hard to get it right.
It's like too much or too little?
Too much or too little. So I think most people are either under hyping it or overhyping it. It's very hard to get it right. But one thing is very obvious to us is that the pace of the change is unprecedented, and it's getting better. Like the DeepSeek just introduced, open sourced all their efficiency engineering tricks to the whole world, and then everybody is going to adopt it. So all of this is pushing the efficiency frontier. So we're getting better and faster every day. So people should be prepared for the big change.
All right, Ben, thanks a lot. We really appreciate it. Ben Ren, he's founder and CEO of SigTech. It's like a Goldilocks thing. It's like no one actually knows, so it's either going to change the universe or it's going to ruin it. Somewhere in between.
$350 billion of CapEx.
Yeah, wow. That is definitely not chump change. All right, the market off continues here. You're taking a look at the S&P down by 100 points, down almost a full 2 percentage points. We're still above that 200-day moving average. We're getting close. We're about 25 points away there. Let's go to Charlie Pellet right now for a Bloomberg Business One.
All right, thank you very much, Alex Steele. Indeed, very close to session lows. Very slight bounce off the bottom, but as you mentioned, we got the S&P down 99 now, 57.50 where we stand. That is a drop of 1.2%. This Bloomberg Business Flash is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. S&P down 1.1%. The Dow now down 747, decline there of 1.7%, while NASDAQ is down 272 points for the NASDAQ Composite Index, a drop now of 1.5%. The Russell 2000 Index of small cap shares hard hit, down 2.4%, with the 10-year currently yielding 4.13%, the 2-year 3.88%. Gold up $16 the ounce, $29.08, gain there of just about 0.6%. West Texas Intermediate crude down 1.2%, $67.56 a barrel. And Bitcoin now down 3.4%. Bitcoin at $82,440. 40 on Bitcoin. From New York to London and Tokyo, equities are falling, with the S&P erasing its $3.4 trillion post-election rally. Automakers are lower now on the imposition of tariffs on Canada and Mexico. John Murphy is an equity analyst with BofA Securities.
Shutting off Canada and Mexico is a very difficult thing to do because it is a contiguous supply chain that has been set up for decades to be very efficient. I mean, there's a lot of parts in Mexico that you can't get Americans to make, or could you pay Americans, cost effectively to make, that would actually be in higher cost than 25% to bring them back to the U.S. So it would be deleterious to the whole value chain.
John Murphy of BofA Securities. Ford shares down now by 3.2%. GM trading lower by 3.8%. So again, recapping here, stocks lower, S&P down 1.7%. Back we go to the Bloomberg Invest Conference. Once again, your hosts, Paul Sweeney and Alex Steele.
All right, Charlie Pella, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We are live here at the Bloomberg Invest 2025 conference down here at Brookfield Place, formerly known as World Financial Center. I used to hang a shingle down here at Merrill Lynch back in the day, so some good memories here. I tell you, if I were to come back on the street, Alex, again, I'm telling you, private credit might be the place I go. I mean, I went to the Chase Manhattan Bank Credit Trading Program, the best on the street. I could go run circles around these guys. I should have done that. Mark Lipschutz joins us. He's co-CEO, Blue Owl Capital, speaking here at our conference here today. We appreciate getting a few minutes of your time, Mark. Talk to us about Blue Owl, how you guys fit into the private credit business, because Alex and I are just amazed at the funds that are flowing into that market.
Well, first I have to find out how to recruit you to join Blue Owl, because we're looking for the best of the best at Blue Owl.
He's probably open.
Credit training. It's all about the people.
It is.
Yeah.
So, and I also want to say it's great to be back down here. My first apartment in New York, when I moved here in 1991 to work at Goldman Sachs when it was at 85 Broad Street, right down that street.
Me too. That's where Salomon Brothers put us up back in the day.
Ah.
So I could say I lived down here and had a water view and all that kind of stuff.
Lovely.
Talk to us about private
Yes.
credit. You guys are just a part of just an amazing asset class.
Well, we've been very fortunate to be part of an asset class, and I play our role in helping evolve it. Look, private credit, to set the stage, right, is about taking long-term capital from investors, and we've tried to broaden the range of people that have access to it, and to be able to provide that capital to corporate users to support their growth with a view to the long term. And to be here on a day when the public market is so volatile, in some ways is very much a reminder of why private credit works for investors, but also why it's important. Because look, we're doing business today. We're making loans today, just like we were yesterday, just like we will tomorrow. Screen red or screen blue, or screen green. Prefer green.
Green. I should disclose that through my money manager, I do own shares in Blue Owl Private Credit.
Oh, thank you.
So I do have some of that. I feel like I need to say that.
Thank you.
But it's not through me. It's through my money guy.
Okay.
So help me understand the competitive landscape, though, because it feels like banks now want to get a slice of the private credit market that they had to give up. And now we're seeing some partnerships with private credit shops. How do you look at it?
Yeah, the evolving landscape with the banks is pretty interesting. Let's make a couple observations. The word, like referencing the bank market, I think is worth unpacking a little bit, because as obviously you will know, when we go back to 30 years ago, I started in the private markets. The alternative market wasn't called that at the time. And we actually borrowed money from the banks when we were doing an LBO, as it was called then, literally from their balance sheets. That over the last 30 years has been on a long trajectory, changing from being a lender to now the banks don't lend to these companies at all. And that's been true for a while. They intermediate, right? They'll go in and they'll underwrite a loan and then sell it into the market, cut it into pieces and sell it. And so in that regard, of course, that's an alternative way to finance a business. And we could talk about the pluses and minuses of both. It's great to have both markets. You want to have a good, vibrant bank intermediated market. But remember, what the bank cares about is, can I underwrite the loan and sell it in the next 60 days? So the red screen today is dramatic for a decision for a bank to underwrite a loan. On the other hand, we're the exact opposite. It doesn't really matter to us what's happening in the market today. What matters to us is, do we get paid back 5, 6, 7 years from now? That's our decision. That's what we're focused on. So in that sense, we really live in kind of with different incentives and serve a different function. However, to the good point, the banks are saying, okay, but turns out private credit really does work, right? They spent a lot of time criticizing the market and trying different ways to maybe scare up the boogeyman. But now they, in fact, are actually launching funds to do private credit. So I'd start with, look, if you can't beat them, join them, and that's great. We'll take the endorsement of the market. It's a big world. Credit's a multi-trillion-dollar asset class, multi-trillion-dollar marketplace. We need vibrant, available capital, and having a bank launch a fund, great. There's a lot of funds in the world, and some of those will be done in partnerships, as you noted, and some will just be standalone efforts, and some will just continue to stay the course and do their traditional underwriting.
What's a typical deal for Blue Owl these days?
So a typical deal for us, and this has been true for us from the beginning. Now, obviously, the attributes and the size have changed. But over the last roughly 10 years that we've built Blue Owl, our reason to be was to come in and say, look, we want private credit to become the lender of first choice as opposed to the lender of last resort. And private credit, if you go back before that time, was really a lender of last resort. It's where you went if you couldn't get money from a mainstream source. As I said, I was at KKR for 21 years, and during that time, I don't recall ever working with a private lender. That just wasn't what you did if you were a mainstream borrower. But the idea for Blue Owl and today, so to answer this question, has been to create actually a real value proposition in having a partner to really work with, a long-dated capital pool for someone who has long-dated needs and long-dated ambitions with their business. So our typical company today, often backed by a private equity firm, a sponsor. Sometimes it's just private family-owned businesses or other corporate enterprises, but typically a private equity-backed business. And they're buying a very large company, and they're looking for a long-term partner to buy it. So typically when we do a transaction, we're lending maybe 40% of the purchase price, and the buyer is putting up 60% of the capital. So that's it's a very, very low leverage structure compared to what people are used to. If you go back again, 10 years and 20 years. And the company today, our average company in our portfolio has over $200 million of EBITDA. I mean, these are big companies today. And that's been a dramatic shift from 10 years ago when it was really a market for smaller businesses.
So let's get to that 5 to 7 year time horizon, because 10 years ago, that's the exact same conversation I'd be having with private equity, right? And then we see where things get tough and things get stickier when vintages don't work out or they come under different times of market stress. How does that apply to the credit space?
So I think it applies for sure in the sense that every market evolves and every market will have its maybe slightly higher and lower moments, but there's an important distinction.
Okay.
At the end of the day, private equity, if I kind of use this metaphor, private equity, which is a business I personally participated in for decades, is about mining for gold, right? It's about going out and maybe in our simplified parlance, you might call them the get-rich strategies. It's how do you go out there and shoot the moon on great returns. So they're mining for gold. Our business in private credit is to be the picks and shovels provider to those miners. So we're not trying to find a big gold vein. We're not betting on the price of gold. What we're saying is if the miners are active, and miners in this case would be any corporate user of capital, so they are always active, we want to supply them, and we take a less risky position, and we expect a corollary attractive return. So on the one hand, of course, every market evolves, and I don't want to suggest anybody lives in a vacuum, but the purpose of our strategies and the purpose of private credit from an investor's point of view is to have something that's much more about downside protection, stability, and income generation through times of uncertainty, which is a bit why I say this sort of red environment today is actually a good time to have the conversation, because what we're trying to build our portfolios and successfully have done over $100 billion of loans, and our running loss rate has been 11 basis points. And I think it speaks to the idea that this is about durability and predictability when times are uncertain. And I think it's probably safe to say today, everyone's looking around saying, gosh, it feels uncertain out there.
Mark, we got about a minute left. What do you say to those folks who say, as the business evolves, the dollars get bigger, regulation is needed? What do you say to those folks?
Well, we're a highly regulated business as is.
Okay.
So, today, look, we're regulated by the SEC. We're a public company as a manager. We have public vehicles. We have a lot of regulators we work with constructively. Happy to do it. I don't think if what we mean by more regulation is more direction from sort of a central source as to what you should or shouldn't lend money to. Remember, when we look back where the sources of problems have been, they actually tend to be in the regulated institutions, not outside, even recently. Of course, everyone remembers the financial crisis, but don't forget, over the last few years, as private credit has thrived, one of the moments we worked through was the run on the bank at Silicon Valley Bank.
Yep.
So, what's old is new. If you have one-day capital and you do long-term things with it, that's challenging. We have long-term capital to do long-term things. So I think at the end of the day, look, we don't touch depositors. We're not systemic. So it's a nice complement to a traditional banking market and a public marketplace.
Great stuff, Mark. Thank you so much for your time. Mark Lipschultz, Blue Owl Capital, co-CEO, talking about the private credit business and what a growth business it has been for sure. All right, right now, we need to get a data check. Let's go to Charlie Pellet.
Thank you very much, Paul Sweeney. And here's what's happening. The Dow, the S&P, NASDAQ all declining as stocks get hammered across the board, indeed across the globe, as concerns about the impact of a trade war on the global economy spur a flight to short-term bonds, gold, and haven currencies. S&P 500 index wiping out its $3.4 trillion post-election rally, and that was after the U.S. imposed the largest set of new tariffs in nearly a century, slapping levies on a broad swath of goods from China, Canada, and Mexico. Keep it locked in to Bloomberg Radio for the very latest. Right now, the S&P is down 1.5%. We're lower by 87 at 57.62. The Dow down 676, down 1.6%. NASDAQ down 1.1%, down 208 now. To be sure, we're off session lows, but still looking at a 2.1% drop in the Russell 2000 index of small cap shares. The 10-year at 4.15%. The 2-year currently yielding 3.90%. Gold up $17 the ounce, up 0.6%, $29.09. And West Texas Intermediate crude down 1%, $67.68 per barrel of WTI. Tesla suffered another big drop in its China wholesales last month as BYD pulled further ahead in the world's biggest EV market. Tesla shares today all part of a broader tech sell-off. Tesla down by 5.9%. Recapping, S&P lower by 1.5%. Back we go to the Bloomberg Invest Conference. Once again, your hosts, Alex Steele and Paul Sweeney.
All right, thanks so much, Charlie Pellet, Alex Steele here alongside Paul Sweeney. This is Bloomberg Invest 2025. We are down here at the New York Financial District. This is where all the big names in finance, banking, asset managers, private credit, private equity, all come together and talk about the way forward. And part of that way forward is the policy that's going to come out of Washington, D.C., and any more insight we'll get on that on tonight's State of the Union with President Trump. So we want to go to D.C. with Nathan Dean. He's Bloomberg Intelligence Senior Policy Analyst. Nathan, there's so much to unpack here, but markets are down. Trade war is on. Does President Trump look at the stock market today?
No, I don't think so. I mean, I think President Trump, this is a long-term message from the White House in terms of these tariffs. President Trump has been saying for months that tariffs are his favorite word, or maybe his fourth favorite word, depending on when he talks about it. But, and I think this was anticipated. I mean, everybody was thinking, is he going to do this? Is he not going to do this? But tariffs were going to come. It was just a matter of the size and the scope. Now, look, President Trump negotiates. That's what he does. There's always going to be a negotiation. But the response that we have seen from Ottawa and Mexico City today suggests that those negotiations aren't going to be taking place right away. This is going to need some time to cook. So I think what you're going to see tonight in this joint address to Congress is you're going to see President Trump double down on this idea of tariffs, an idea of bringing back manufacturing jobs to the United States. His Truth Social posts about farmers growing stuff in the United States to sell in the United States. That's the message that you're going to hear tonight. Wall Street probably isn't going to like that, but I don't think you're going to see any reaction from the White House in terms of Wall Street for a couple weeks at the earliest.
So, Nathan, what is the feeling in D.C. amongst, Congress, just the system, the bureaucracy about where this is all going here?
Yeah, so there's going to be a lot of unease, especially amongst the Republicans in terms of these tariffs. Senator Rand Paul even just tweeted 2 hours ago that, look, tariffs are going to increase prices, and he cited automobiles, that auto prices are going to go up as a result of these tariffs. Senator Grassley from Iowa, he's going to have a problem this tonight as well, because as President Trump says in the speech, look what I did in terms of the tariffs. Well, China put retaliatory tariffs on soybeans, and there's a lot of soybeans that go to China from the United States. So I think what's going to happen is over the next few days in terms of this Republican response is they're going to wait to see what happens. Now, Target and Best Buy have already said that price increases are probably going to be coming in the next few days. Is this enough to get President Trump to change his mind? Probably not. But as these farmers talk to folks like Senator Grassley, they're going to be saying, look, soybeans are down. We don't have a place to sell. So if you're not going to give us tariff relief, then you have to give us subsidies via a farm bill package. So there's a lot of unease negotiations here to be taking place between Congress and the White House over this tariff policy.
Which is what we heard from Justin Trudeau of Canada, saying we're going to support businesses that are going to be hit by these tariffs when he was speaking earlier today. So this all comes ahead of the State of the Union. Nathan, what's going to be, say, the top 1 or 2 things that you need to hear to help, I don't know, make a policy decision, have conviction on where we're headed?
Yeah, so when it comes to tariffs in particular, I'm not exactly sure what look, we're going to be seeing if there's any nuggets that President Trump says in this speech that Canada and Mexico can come back with. Now, President Trump has always said this is about fentanyl. You know, I'm not exactly sure if I believe that. The reason being is that, you know, the Canada-Mexico agreement from 1 month ago, 10,000 troops on the border and so forth, Prime Minister Trudeau even just said this morning that, you know, they've done that. What I need to see from President Trump is this idea of, is there any way that we could scale down the Canada and Mexico tariffs? Because if you remember over the weekend, Howard Lutnick was saying that potentially there's some flexibility here. And so I'm looking to see if there's any additional statements that he says that Mexico and Canada can do. But I also remind folks that on April 2nd, we have reciprocal tariffs. So if President Trump double downs and says, look, reciprocal tariffs are coming, I don't think you're going to see much of the way of this trade war ending anytime soon. The other thing that I think investors should pay attention to tonight is this tax reform debate. Because President Trump has said certain things like, look, I want to make these $4.5 trillion in tax cuts permanent, but at the same time, I don't want to touch Medicaid spending. So I want to see direction from President Trump towards Congress and specifically those House Republicans to see if he's going to put any leverage on them to support his goals there.
So what is the status of the tax package and the various economic packages? Because a lot of folks, Nathan, are telling me this is when the rubber's going to hit the road in terms of Democratic responses.
Yeah, so, you know, in terms of this tax package, where we are is the House passed their budget resolution last week. Now, this wasn't a bill, this wasn't legislation, this was essentially a blueprint. And so what they said is, here, go forth, and this gave instructions to 8 House committees to go forth and look for $2 trillion worth of $2 trillion worth of deficit reductions to offset the $4.5 trillion in the tax cuts are going to cost. Now, there's economic growth, there's tariff money, and all of it should come approximately close. The challenge is that even though the House says that they want to get something done in April, if not May, the challenge is how are you going to pay for this and how are you going to get the entire caucus on green? Because if you cut Medicaid, you've already lost several constituencies. If you increase the deficit, you lost others. So, you know, Speaker Johnson has this really tricky situation of trying to get everybody on the same page. What we're telling our clients is, look, there's no deadline here that's going to force the House Republicans to come up with a solution until the end of the year. So they have all this year to figure it out. So we don't think this is going to happen until the fourth quarter. We do think a package will eventually come together. We do think we'll, you know, extend these Trump-era tax cuts, but we don't think it's going to change the Inflation Reduction Act all that much. We probably don't think it's going to change Medicaid all that much, you know, but again, it's hard to come up with specifics because they have the rest of the year to figure it out. It's just not going to happen in the time frame that they're currently saying it's going to.
Right, and that therein lies the issue for the market. So the stuff that's negatively impacting the markets, like tariffs, Trump can do on his own and have an immediate effect. But the stuff you're talking about, like tax cuts that can have a stimulative effect on the markets, can't be just done by President Trump, has to be done by Congress. So the longer that gap is, you have to wonder if it's going to be harder for the markets to digest.
Yeah, absolutely. So if you think about 2025 and think about catalysts, key things that are happening, you know, right now we're going through the trade war. The trade war is probably the most important thing that's to the markets at this point because, look, we're seeing it in real time. You know, we're seeing companies saying prices are going to go up. We're seeing the peso and the Canadian dollar go down. But then if you get longer term, we have a government shutdown coming up March 14th. Very little impact to markets. In fact, every single time this happens, we put out notes essentially saying there's no market impact from a government shutdown. Next after that, you have the debt ceiling. This is probably June, July. You know, obviously, if you're on the fixed income side, you care very much about the debt ceiling. We think there's an 80% chance the debt ceiling is resolved with. So we, again, don't think a lot of headline risk. We don't think there's really all that much to be concerned about. But then the next one is this tax reform debate. That takes place towards the end of this year. So this tariff argument in terms of market angst, this is going to continue throughout the year because ultimately it's President Trump's decision on when and if this trade war ends. And so there's a lot of uncertainties that are coming out from Washington right now.
All right, Nathan Dean, thank you so much. We appreciate that. Nathan Dean, a Bloomberg Intelligence Senior Policy Analyst. We're waiting for another panel to get seated here, and if they start on time, we'll get it to you. But in the meantime, we want to check in with Michael McKee, Bloomberg International Economics and Policy Correspondent. And Michael, just listening to Prime Minister Trudeau's comments, Canada's not waiting to retaliate here, but I guess they're still trying to extend an olive branch, but it's happening fast and furious.
I'm not sure about the olive branch, Paul. Justin Trudeau was pretty straightforward about his anger and how he framed this as something that Donald Trump is doing to Canada and doing to the American people for no reason. So, kind of an interesting thing.
Hey, Mike, when we take a look at traders pricing in plus 50% chance of a rate cut now in May. Now we're pricing in 3 cuts in 2025. I mean, do you think that this is, we could see that?
Oh, we could. I'm not paying any attention to what markets are pricing for the Fed right now because there's just too many unknowns. We have, as Bob Rubin was just talking about on the latest Bloomberg Invest panel, he was saying that yields are falling because the economy is slowing and markets are worried about a downturn. If that happens, then the Fed's going to be cutting rates, and it doesn't really matter about tariffs except that tariffs helped cause them. If the Fed figures out from tariffs that we're going to have an inflation problem, but the economy is going to remain strong, and they are going to leave rates where they are. And so it's really hard to tell at this point what monetary policy is going to be. Self-interest promotion here. I'm speaking with John Williams of the New York Fed at 2:20 this afternoon at Bloomberg Invest, and he'll be the first one from the Fed to comment on the tariffs. And I suspect he's basically going to say, we still don't know yet. This is new, but back in 2018, the Fed staff laid out the choices for the Fed. Let the tariffs take effect and anticipate inflation, so you raise rates, but you probably bring about a recession, or anticipate that the economy is going to slow, so you cut rates. The Fed started to do number 2 there, but then COVID interrupted it. So it's a decision yet to be made, and they'll have to figure out exactly what the best course is based on what they can figure out from the president's actions now.
Hey, Mike, when do you expect to see some of this, either inflation pressures or slowdown in the economy? When do you expect that to kind of be seen in the numbers?
We're seeing some of it already, Paul, because, of course, there was a big surge in imports of material goods for factories in January as people tried to get ahead of the tariffs, and that should show up in inventories as well. But I don't think we're going to see, say, impacts from the tariffs for another couple of months, because it takes a while for all of that to get into the price chain. And then the question for the Fed, the important question is, are there second round effects? Do employees start to ask for more money? Do companies start to raise prices because they're paying more? So it's going to take a while for that. What we might see sooner, and this is not going to happen on Friday with this jobs report, but we might see sooner job layoffs from DOGE that then extend beyond federal employees, because there's less money being spent because there are no federal employees to spend it.
Mike, before we let you go, you deep teased John Williams' interview later on today at Bloomberg Invest. What's going to be your follow-up to the tariff Fed cutting question? Because you got to have one. You got to have 3 follow-ups.
I got to have 3 follow-ups. I got to have more than that. I mean, obviously, we ask his reaction, but then what is his view of the 2018 Fed strategy? Because the idea that you look through the tariffs and cut rates if you need to is based on the idea that this is a one-time increase in the price level, but not ongoing inflation. Well, that was true in 2018, but would it be true this year, because Trump is talking about more tariffs next week and more tariffs at the beginning of April? And so you could see this rolling impact on inflation that the Fed would have to respond to. So we'll ask him about that. And he knows, I'm sure, everything we're going to ask about the tariff.
Yeah, that's coming.
Yeah.
Yep.
Well, and then to that point, Harvey Schwartz of Carlyle was saying something similar, that if it's just a tariff, it's a one-off, it's trade wars, that's when we get into a higher inflationary environment. Mike McKee, thank you very much. Looking forward to that panel later on today. Bloomberg International Economic and Policy Correspondent Michael McKee. Quite a day here. For our listeners in the U.S., here's a reminder for you. It's an important one. You can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Balance of Power is next after this global news update. And I should point out here, we are off the lows of the session around 11:30. It looked like markets kind of bottomed out and are now trying to grind their way a little bit higher. We're now down only 1.3%. But considering that we were starting to get a little nervous there, but the S&P and its 200-day moving average, that nonetheless is significant, but is still a tough tape out there. So good luck trading, everyone. This is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. Canada's Prime Minister says the U.S. has launched a trade war, and Justin Trudeau calls the new tariffs imposed on his country a dumb thing to do. He says Americans will pay a steep price.
Your government has chosen to do this to you. As of this morning, markets are down, and inflation is set to rise dramatically all across your country.
He says Canada will not back down from a fight.
Should these tariffs not cease, we are in active and ongoing discussions with provinces and territories to pursue several non-tariff measures which will demonstrate that there are no winners in a trade war.
China has announced retaliatory tariffs. Mexico plans to next weekend. Business analyst Jill Schlesinger.
These tariffs will start to change the way people, individuals, and businesses spend money. That could mean that we see them pull back. Growth could start to pull back.
Analyst Michael Farr says the Federal Reserve will watch how this plays out.
They've got to stop inflation, and in order to do that, their only tool in the box is to raise interest rates. If this keeps up, you could see a rate hike before the end of the year rather than a rate cut.
To Washington, CBS's Tony DeCopel is on Capitol Hill, where tonight President Trump will address both houses of Congress.
We've been told by the Speaker of the House to expect fireworks tonight, so while a typical joint address might be a somewhat boring, somewhat somber list of goals from a new president, you can expect President Trump to instead tout action, accomplishments, and there's been a lot of that. Maybe no president since FDR has attempted so much so quickly.
Ukraine's President Zelensky said today he wants to make things right with President Trump now that the U.S. has suspended aid to his country. The Vatican says Pope Francis has stabilized enough today after 2 respiratory crises to be taken off non-invasive mechanical ventilation. CBS's Chris Livesay in Rome.
The pontiff remained alert and cooperative throughout this entire ordeal, but his prognosis remains guarded, meaning doctors still can't predict if he's going to get better or worse.
Now to New Orleans. Fat Tuesday Mardi Gras celebrations limited some by the weather. Meteorologist Craig Allen.
There will be clusters and lines of showers and thunderstorms with damaging winds, possible tornadoes. There is a tornado watch in effect across the lower Mississippi Valley. Some may be strong, EF2 or higher.
And checking Wall Street right now, the Dow is down 665 points. This is CBS News. At the South Pole, scientists are watching as the world's largest iceberg is run aground.
At 4 times the size of Greater New York, when the world's biggest iceberg moves, the world's scientists take notice. Called A23A, it broke off the Antarctic ice shelf back in 1986 and has been slowly drifting through the area known as Iceberg Alley ever since. But now it's stuck in shallow offshore waters. As A23A starts to break up in the warmer waters, scientists say it will release a huge amount of nutrients, creating, they say, an explosion of life in the course of its death. Vicki Barker, CBS News, London.
Texas Lieutenant Governor Dan Patrick's pushing to rename the New York strip steak the Texas Strip. In his states, the Republican says the change would boost Texas cattle ranchers and that, quote, liberal New York shouldn't get the credit for the cut. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Fat Tuesday becomes Tariff Tuesday. Welcome to the fastest show in politics as President Trump implements tariffs against Canada and Mexico just hours before addressing a joint session of Congress. We've got a big day in Washington, and the retaliation has already begun, as we'll discuss in a moment with Bloomberg White House correspondent Josh Wingrove. Trump tonight will surely say, drill, baby, drill. We'll get into the impact tariffs will have on energy prices and Trump's policy overall with Tom Kloza from Opus. And we've got our signature panel with us on this day in Washington. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, getting us ready for the big speech tonight following the tariffs taking effect this morning. We've, of course, got our eyes on the financial markets with big implications here when it comes to these tariffs. And that's where we start today with Charlie Pellet at World Headquarters in New York. Charlie?
Thank you very much, Joe Matthew. I've got you covered on stocks. The Dow, the S&P, NASDAQ all declining. Wall Street wondering just when President Trump might step in as stocks keep falling. Another down day, and here's where we stand with the S&P now lower by 1.3% to 5771. That is a drop of 78 points. The Dow down 683. For the Dow Industrials down 1.6%. The NASDAQ Composite Index down 0.9%, while the Russell 2000 Index of small cap shares, especially hard hit, down now by just about 1.8%. We've got the 10-year yielding 4.15%, with the 2-year right now 3.90%. Gold up $23 the ounce, $29.15, up by about 0.8%. And West Texas Intermediate crude down 0.9% now, $67.77 a barrel. Bitcoin trading lower by 1.9%. Bitcoin at 83,631. Stephanie Roth is chief economist at Wolf Research. She says no question the U.S. economy is now facing significant headwinds.
The combination of the policy mix probably couldn't get worse at this point. Of course, things could always get worse. Yeah. But if you were to define something that's really quite negative for the economy, this is it. We have government layoffs, the private sector is getting squeezed. We have these massive tariffs, which, by our estimates, that could shave about 1 percentage point off the U.S. economy.
Stephanie Roth of Wolf Research. And again, the 10-year now at 4.15%, the 2-year 3.90%. Stocks getting hammered across the board as concerns about the impacts of a trade war on the global economy spur a flight to short-term bonds, gold, and haven currencies. Earnings news now. Target and Best Buy are warning consumers to expect higher prices as a direct result of the tariffs that President Trump imposed on Mexico, Canada, and China overnight. Now, speaking on CNBC, Target CEO Brian Cornell said its shoppers will likely see price hikes in its stores over the next couple of days. Today, we do have Target after earnings down now by 5.5%. Best Buy after earnings down by 15%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much, setting us up perfectly here on Tariff Tuesday. Welcome to the fastest show in politics. It's the Tuesday edition of Balance of Power here on Bloomberg Radio, on the satellite radio channel 121, and on YouTube, where you can find us right now. Search Bloomberg Business News Live as we count down to the big speech. 9:10 p.m. Eastern, they tell us. But things have a way of sliding when everybody wants a handshake and a hug coming down the aisle. We will have special coverage of the president's address to Congress starting 8 p.m. Eastern time tonight on Bloomberg TV and radio. On Tariff Tuesday, they took effect earlier today. The president said this, as you heard live on Bloomberg yesterday, 25% tariffs on Canada and Mexico. Here is the president of the United States.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariffs. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs.
Well, they are as of now. Mexican President Claudia Sheinbaum says, give me till Sunday, having said we've got Plan B, C, and D ready. That's when countermeasures, as we reported here at Bloomberg, will be announced. Canadian Prime Minister Justin Trudeau not waiting around. In fact, he spoke a short time ago, as you heard live here on Bloomberg. Let's listen.
There is absolutely no justification or need whatsoever for these tariffs today. Now, the legal pretext your government is using to bring in these tariffs is that Canada is apparently unwilling to help in the fight against illegal fentanyl. Well, that is totally false.
Really interesting to hear the Commerce Secretary, Howard Lutnick, on the other network this morning saying this is not a trade war, this is a drug war. Resetting the trade policy is what comes April 2nd, those reciprocal tariffs we're talking about. If this is all about fentanyl, we know that Canada and Mexico are in two very different places. And that's where we start our conversation with Josh Wingrove, Bloomberg White House correspondent, with us at the table. It must be a big day if you're here in person. Thanks for joining us.
I'm here to serve, Joe.
Well,
what's
I
going
love
on?
You for it. So,
you know,
there's nothing they can do in the meantime, apparently, to prove that they've made good on some of these concerns, as Justin Trudeau outlined, the measures that have been taken to stop the flow of fentanyl, the money spent on securing the border. What is it that Donald Trump wants?
I mean, it is the Prime Minister's belief, you heard him say it today, that this has been essentially a ruse, that there was no sincere effort on fentanyl that could have alleviated these. He said he'd been holding out hope that it was, merely a bargaining chip or negotiating tactic. Obviously, that has not been the case, or at least as we sit here now, is not the case. And so, he's moving to essentially sort of trade war footing. And it's, the clip that you played from President Trump, well, is it about factories being stolen or is it about fentanyl? It is tough to say. And then Secretary Lutnick this morning saying this is a drug war, not a trade war. The trade war is just 3 weeks away. So, right. All these things are kind of coming in together. And for those people who are just tuning in to these threats, I think a lot of people have been tuning this out, right? Trump makes a lot of tariff threats, a lot of tariff threats. In the first term, he made a lot of them. The scale is so much bigger now. I think that's really important to understand. This is not just hitting steel and aluminum, and in particular, only certain countries with steel and aluminum. He today has enacted these tariffs, 25% Canada, Mexico mostly, 10% Canadian energy, 20% on China, on the three biggest trading partners, also the three biggest customers of U.S. products. He's picking a fight with the three countries that have the broadest firepower to fire back. This is structural, and there's more stuff coming down the pipe next week.
Yes.
Steel and aluminum tariffs, 25%, potentially rising above that. Following that, April 2nd, both the reciprocal tariffs and the sectoral ones, both of which could pile on to Mexico and Canada, by the way, and fuel these responses that we're already seeing. So we're in it right now.
Well, we're considering conditions that could be met. The first time I've heard this was in that interview with Lutnick earlier today. We need to see material reduction in autopsied deaths from opioids. Yeah. You cover this White House closer than anyone I know. Have you ever heard that line before? Is that the new metric?
The first time we heard that metric was about a week ago.
Okay.
And that felt
what does that mean?
To the Canadians like a goalpost moving scenario.
What's material?
They want to see a reduction in fentanyl deaths in the U.S., which, of course, everyone wants to see.
Autopsy deaths. Why include that term?
I'll leave it to the Secretary to say why he said that. A week ago, what we were told by a White House official is fentanyl deaths in America need to come down before these tariffs go away.
Yeah.
That was what we reported. To the Canadians and Mexicans, that was new to them, because not only have they been saying, well, it's kind of unclear what we've been asked to do, but the public reasons were things like fentanyl at the border, in other words, seizures, border enforcement, that kind of thing, as opposed to domestic fentanyl deaths. I should note, Canada, like many other Western nations has its own problem with fentanyl deaths that they're trying to, most developed economies are grappling with the scourge of this. So that was, to the eyes of many Canadians, a goalpost shift. To the eyes of the Americans, that is the current metric, saying these tariffs are staying in place until that. So I should note, if you are, for instance, a Canadian steel producer, you might be facing tariffs of 25 on steel, plus 25 allegedly on drugs today, plus the reciprocal tariff, which, by the way, Secretary Lutnick made clear today is still coming down as well, and will count, for instance, the Canadian GST, which is a federal sales tax on all goods, imported or not, as a tariff in responding kind. So you could have 3 tariffs if you're a Canadian steel producer. You can imagine what that does. For instance, Stelco, recently bought by Cleveland Cliffs, based in Ohio, home state of the vice president. Wonder what they think about all this.
Well, we've heard from Canada that this could mean an immediate recession in the Canadian economy. But what's going on here? Look at this market. Biggest loss yesterday of the year, the S&P 500 back to where it was before the election, and we're not slowing down. Even crypto is falling. You've seen the reaction on the bond market. Donald Trump seems to pay attention to that. What does he think of this Wall Street reaction?
Many of the president's close supporters that I talk to will say that the market reaction is one of the few things that is a true metric for him, that he believes strongly in it. And so you have to think that he's taking this seriously, but they're also saying, look, there could be some temporary pain. So I think some people in his administration kind of expected an initial reaction, and the question is it more prolonged or deeper? But I do think that President Trump just has been talking about this for a while. On the Canada stuff, he keeps raising Canada. He's not asked about Canada. Joe, I'm Canadian, and in these rooms, no one's asking about Canada. He just keeps circling back to it. And so I think that it is clear that Canada is on his mind, and he wants to, pressure the country. And we should also know that in about a week, there'll be a new prime minister, and then potentially a couple months after that, maybe even another new one. So this is coming at a point of, transition in the leadership of the federal government in Canada.
Some have suggested he could help to get Trudeau's party reelected. There's a political backlash here.
Trudeau's party was on the mat in polling,
not so much
and has
now.
Completely rebounded because
is that
of
where
this.
We're going?
And now it is a much closer election between the Conservative Party, which had looked like it was primed to be sort of like cruising to a strong majority government mandate, and now it's loose to say.
We've only got about a minute left. Of course, saving all the good stuff for the end here, but this big speech tonight, they're talking about 2 hours. Is that real?
A standard Trump speech is like an hour, so.
Well, that's true. Democrats are talking about bringing noisemakers into the hall tonight. What are we in for?
I'm thinking of getting pizza, so I'll just speak for myself. Look, he wants to do a few things. He wants to give a victory lap. Obviously, the current market reaction will dampen that. He does want to call for things, including additional border funding. We've heard, Tom Homan talk about the need for further resources. So he is coming with a wish list, not just a celebration of what's being done. But other than that, we're going to hear a lot about the border. We're going to hear a lot about a theme of restoring the American dream, which will dovetail on tariffs. We will hear stuff on Ukraine. We'll be watching closely for a response to what we've heard from President Zelensky about an hour and a half ago, sort of opening the door again to further talks. So there'll be a lot of news in it, I think.
He likes to make announcements.
He likes to make announcements, but
does he want to get in the mix with Democrats? Does he want to get into a little call and response a la Joe Biden?
I guess we'll see.
This could be a night, huh?
Yeah, he doesn't have Pelosi over his shoulder now, so it's a little bit of a different dynamic.
So much body language to watch, and of course, much messaging ahead today. Josh Wingrove, thank you so much, Bloomberg White House correspondent, setting us up for the big speech on this Tariff Tuesday. Our special coverage starts 8 p.m. Eastern Time. Stay with us on the fastest show in politics. I'm Joe Matthew. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all declining. We're off session lows, but still looking at a 65-point drop in the S&P 500 index, down 1.1%. Dow Industrials down 617 on the Dow, a decline right now of 1.4%, while NASDAQ is down 108, decline there of 0.6%. 10-year at 4.17%, with the 2-year currently yielding 3.91%. Gold up $22 the ounce, up 0.8%, $29.15. And West Texas Intermediate crude down 0.7%, $67.90 on WTI. Bitcoin down 0.9%, off session lows at 84,600 on Bitcoin. Well, certainly the automakers watching any tariff developments closely. Yesterday, Bloomberg News reported the tariffs could potentially raise the cost of cars coming out of Detroit by $12,000 a unit. Bloomberg's Barry Ritholtz has just wrapped up a conversation with Chicago Fed President Austin Goolsbee.
So I've been out in the Fed 7th District, which includes Michigan, and talking to leading auto executives and auto suppliers, and they've highlighted that tariffs, especially on Canada, Mexico, when Canada, Mexico, the U.S. is such an integrated supply chain, they've highlighted that these tariffs on intermediate goods, that is on parts and supplies and components, are going to mean higher production costs, and they're going to translate into higher prices on consumers.
Chicago Fed President Austin Goolsbee speaking with our Barry Ritholtz. Again, Ford down 2.6%, General Motors down 2.5%. Recapping, stocks lower, S&P down now by 1.1%. The tariff, the 10-year on this tariff Tuesday, 4.17%. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet. That's a Bloomberg Business Flashback. We go to Washington. Lots going on today. He's looking at a long day. Once again, your host, here he is, Joe Matthew.
Yeah, we're in for the long haul. Charlie Pellet, thank you so much. Speech doesn't start till after 9 o'clock tonight. And boy, we could be sitting here with Rick and Jeannie around midnight on Bloomberg TV and radio. Don't call it the State of the Union because it's his first year. The president will deliver his address to Congress tonight. Having said it will be big, remember, Truth Social, I will tell it like it is, said Donald Trump. And well, we're just going to have to get together around 9 o'clock to find out. That's when it starts. Our special coverage begins at 8 p.m. Eastern Time. The theme tonight, the renewal of the American dream, according to the White House. He's not planning to leave the Capitol until almost make that 11:30 Eastern Time tonight. So we're in for the long haul. I suspect there's going to not only be a lot of handing and backslapping, but maybe some deal making. I'll remind you, the government runs out of money in 10 days. First-term Senator Elissa Slotkin, Democrat, Michigan, in the crosshairs on this Tariff Tuesday, will be delivering the official party response. We'll carry that as well. Does America have a State of the Union, so-called, and an Oscars ceremony in it in the same week? 32 million people tuned in to see Joe Biden's last State of the Union in 2024. It'll be interesting to see what happens here. It's Canada we're watching today, and Mexico, of course, on this Tariff Tuesday, 25% in each direction, north and south. And the retaliation, as I mentioned, has already begun. We heard from Justin Trudeau a little while ago here, and they didn't wait, as I mentioned, implementing retaliatory tariffs of nearly $100 billion of imported U.S. goods, $30 billion effective immediately, another $125 billion in 3 weeks' time. And Justin Trudeau, you know, he has a bit of a light touch, although he was clearly not very happy when he spoke to the press this morning. Doug Ford was smiling. The leader of Ontario, the premier of Ontario, smiling as he suggests cutting off energy for America. Here he is.
A tariff on Canada is a tax on Americans. If they want to try to annihilate Ontario, I will do everything, including cut off their energy, with a smile on my face. And I'm encouraging every other province to do the same.
Well, he wasn't actually smiling, but you get the point. Ontario Premier says Starlink deal has been canceled. We'll add another log on the fire here, raising great questions about what tariffs mean for energy. Of course, Donald Trump tonight is going to say, drill, baby, drill, right? That was the centerpiece of his approach to inflation. Production ramped up. There's been some talk, and we'll get to this with Tom Close, about what Russia might be able to do to lower oil prices. But let's get into this conversation right now with the global head of energy analysis at Opus, an authority on these matters, and always great to have Tom Close with us here on Bloomberg. Tom, happy Tariff Tuesday. We're looking at the reaction in the markets here. World WTI West Texas crude is below $68 a barrel. What are we worried about?
Well, I think that yesterday's news from the OPEC group about increasing production in April has really, I hate to use this verb, trumped the tariff tirade for now, because oil prices moved into the 60s substantially for both Brent and WTI on that news. We're not seeing that much of a reaction right now for Canadian companies and for the U.S. companies that import from Canada. There's one exception, and that's in New England, where Irving Oil, which has a 320,000 barrel a day refinery in the Maritimes, raised prices by 20 to 27 cents overnight. But it's pretty limited. Nothing to observe in the mid-continent, and the discount for Canadian crude, which has been about $12.50 to $13, is about $12.85 right now. So if you didn't know about all of this Sturm und Drang with the tariffs, you would think that crude oil is reacting to other elements, as they should with the OPEC Plus agreement.
And that's something. How much does Donald Trump have to do with that decision, that announcement from OPEC?
I don't know if he has anything to do with it. You know, the year was setting up to be a very, very cheap year for liquid oil. And I think it still sets up that way. You can make the argument that the tariffs and the impact from that, from a trade war, is very deleterious to sort of global GDP. And there's nothing that impacts petroleum demand like global GDP growth. If you take the job cuts and you take the tariffs, you can probably cut into that growth, which most people thought would be somewhere between 750,000 and 1.2 million barrels a day this year.
Mm-hmm. What's going to be the real impact of this tariff program? And I know we're still trying to get our heads around it. Tom Close, markets have been moving in a couple of different directions. You heard Doug Ford there. If they want to annihilate Ontario, he says, I'll do everything, including cutting off their energy with a smile on my face. What does it really mean for the industry, though, and prices?
Well, if he were the premier or the governor or whatever of Alberta, it would mean a lot more, because most of the crude oil that we get, the heavy crude, is from Alberta, from Hardisty. And right now that's trading for about what it did beforehand, and probably scraping around $55 a barrel right now. So the tariff ostensibly would add about $5.50 to that. But we're not seeing it manifest itself in downstream markets yet.
Interesting. Now, let's say they stay in place a couple of months because we don't have a great sense of what it would take to bring them down. And we're looking at Canada specifically here, I guess, when it comes to crude oil. Could this create a disruption in that trajectory, that lower price trajectory that you're talking about?
Oh, yeah. It could mean that the people in the mid-continent who typically have the cheapest energy prices, they might have the most expensive. Canada is a stranded seller. In other words, they export 4 million barrels a day, or just a little bit under that, to the U.S., and they really don't have many other choices. They can move some stuff to tidal water on the Trans Mountain Pipeline, but not a great deal more. The other problem is the U.S. refiners in the center of the country are stranded buyers. It's going to be very, very difficult for them to come up with the crude oil they prefer if Canada is not selling it. But I think the sense out there in the oil markets now, in the energy markets, is that the tariffs on Canada are going to be measured in days, not in weeks or months. I could be wrong on that. Mexico's a little bit more complicated, because Mexico, it's 25%. And a lot of the Mexican crude goes into foreign trade zones, which is U.S. refinery complexes that ostensibly could run Mexican crude and not have to pay the tariff because they'll be exporting refined products, gasoline and diesel.
Huh. Wow. Fascinating. Before I run out of time here, Tom, I heard a fascinating conversation, speaking of which, earlier today on Bloomberg with Dawn Fitzpatrick. This is the chief investment officer at Soros Fund Management. Considering the impact that Russia could have on this whole picture if we got a peace deal in Ukraine, here's what she said on Bloomberg.
The U.S. really can't drill more. It's not in Saudi Arabia's best interest to produce a lot more. They need about $90 a barrel to balance their budget. So the lever he can really pull there is Russia. And one kind of wild card would be Russia dropping out of OPEC. And that would have a real impact on oil price in the context of moving it lower.
Speaking this morning at the Bloomberg Invest Summit, how does that hit you, Tom Closa?
I agree that that's a significant tail risk. If there's a rapprochement with Russia, we're going to get Russian molecules of liquids or natural gas, and that could be very, very harmful to sort of the oil price universe at the moment. Now, that's probably a second half 2025 event if it's out there at all. But, you know, there's some banks who retain bullish views and they go, well, Russia will comply with OPEC. What in history has ever suggested that they would comply with restrictions that are placed upon them? So I agree with Dawn. I think she's spot on that.
What would that mean for crude oil in the second half, the price of crude?
You know, I think that crude, with a Russian rapprochement and with, let's say, an end to some of the tariffs for Canada, I think you're talking about crude oil, you know, having some trades at below $60 a barrel. That's for WTI, maybe about $3 or $4 higher for Brent.
Fascinating.
It's hard to be bullish about crude oil right now. Very, very hard. Right. Despite the tariffs.
Well, you're going to hear drill, baby, drill tonight for sure. Tom Closa, in our remaining moment, what else do you want to hear that might make you feel better about prices this year?
I don't know. You know, we're going to hear about energy dominance, but, you know, ironically, we achieved energy dominance during the Biden administration despite an adversarial relationship. So I don't think that most companies are going to be interested in bringing more hydrocarbons to the market, with the exception of natural gas that they can export. So I think we'll get a lot of rhetoric and we'll get hyperbole, which is very predictable, but I don't think we'll get much in terms of policy change.
It's always great to have you, Tom. I appreciate it very much. Tom Closa, Global Head of Energy Analysis at Opus, with the straight take ahead of the address to Congress later. It starts a little after 9 p.m. West Texas crude, 67.84. We're down about 1% today and apparently heading lower yet if Tom Closa has the right take on things. We'll assemble our political panel next. The signature panel is with us on this big speech day in Washington. Rick Davis and Jeannie Shanzano are on the way in as they put the final touches on the address. It's next, right here on Bloomberg.
It's 1240 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ off session lows, but stocks are still getting hammered across the board as concerns about the impacts of a trade war on the global economy spur a flight to short-term bonds, gold, and haven currencies. Right now, the S&P is down 60. That is a drop of 1% at 57.89. Dow Industrial is down 570 now, a decline of 1.3%, while NASDAQ is lower by 81, a drop there of 0.4%. The Russell 2000 index of small cap shares hard hit, down 1.2%, and the 10-year currently yielding 4.16% with a 2-year 3.90%. Gold is up $21 the ounce, up 0.7%, $29.14 on the precious metal. West Texas Intermediate crude, just talking oil, down 0.6%, $67.93, and Bitcoin at 85,180. Bitcoin now down by 0.2%. Traders now see the Fed picking up the pace of rate cuts, and with that story, here's Bloomberg's Vinny Del Giudice.
Money markets are fully pricing in 3/4-point Fed rate cuts this year. The imposition of tariffs on Canada, Mexico, and China marks a turning point for the U.S. economy. It shows White House threats are more than a negotiating tactic. The Fed next meets on interest rates on March 18th and 19th. Fed Chair Jerome Powell is scheduled to deliver a speech on the U.S. economic outlook on Friday. Vinny Del Giudice, Bloomberg Radio.
Automakers lower on the imposition of tariffs on Canada and Mexico. Ford shares down now by 2.5%. General Motors lower by 3%. Again, recapping, equities lower across the board. Tariff Tuesday with the S&P down 1.1%. The 10-year right now 4.16%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie Pellet driving our way here on the round trip back to levels we haven't seen since before the election. Not a good look after the losses we saw yesterday on Wall Street. Biggest loss of the year yesterday for the S&P 500. We'll see where we end up today. Even if we're off the lows, the market does not seem to be terribly pleased to wake up on Tariff Tuesday, as they're calling it, with new levies in place, yes, against Canada and Mexico. Retaliation already happening from the north. We haven't even talked about China yet. And yeah, it'll probably come up in President Trump's address to Congress later on, but he's got a lot of other things to talk about as well. Bloomberg, of course, obsessing over tariffs for good reason. Look at this reaction. I mean, it is moving markets. But we're going to be listening very closely for news on Ukraine. And over the course of the program today, we'll be touching on a couple of the elements, as we just did Tom Kloza when it comes to energy. Ukraine, we'll get into with our panel here with the headline coming from the White House here. Donald Trump temporarily suspending military aid to Ukraine, impacting more than $1 billion in arms and ammunition in the pipeline and on order. This is a big deal. And it may have a lot to do with the fact why President Zelensky is talking about Donald Trump's leadership here, strong leadership on the road to peace. Vice President J.D. Vance sat down with Sean Hannity on Fox to talk about the peace process and the ask for security guarantees from the United States, keeping in mind this minerals deal that President Zelensky came to the U.S. to sign last week is still sitting on the table. Here's J.D. Vance.
The very best security guarantee is to give Americans economic upside in the future of Ukraine. That is a way better security guarantee than 20,000 troops from some random country that hasn't fought a war in 30 or 40 years. The security guarantee and also the economic guarantee for Ukraine is to rebuild the country and ensure that America has a long-term interest. You're not going to do that if you come to the Oval Office, insult the president, and refuse to follow his plan for peace.
So what will be the message when it comes to Ukraine? What will get members of the Republican conference in the House, the Republican caucus in the Senate on their feet? It's where we start with our signature panel. They're with us for the long haul today. Rick Davis and Jeannie Shanzano as we approach the address to Congress. Bloomberg Politics contributors. Rick is our Republican strategist partner at Stone Court Capital, and Jeannie, of course, our Democratic analyst and senior democracy fellow with the Center for the Study of the Presidency and Congress. Rick, what do you expect when it comes to messaging on Ukraine specifically knowing that Donald Trump wants to make an announcement, will he say that this minerals deal is as good as done?
Yeah, I think that he'll say, certainly from our perspective, it's done. All we need to do is get Zelensky's signature on the page. And obviously, he's putting Zelensky through his paces to get him to the point where that signature looks like it will have been earned by Trump, kicking him out of the White House, saying that he's not ready for peace, freezing the military aid. All these things are a process that Trump wants Zelensky to have to feel the pain before he can, let him come back into a partnership on these minerals. So I think we're probably going to see that in full display tonight. And this is probably the last moment that Trump will use to put Zelensky in a box before he lets off the pressure. So the good news is this may be the worst day of the year for Zelensky, but then again, it probably gets better from here. And of course, I think that's probably what Zelensky's focused on based on his most recent comments.
Jeannie, we heard from Volodymyr Zelensky. My team and I stand ready to work under President Trump's strong leadership to get a peace that lasts. The first stages could be the release of prisoners and truce in the sky, ban on missiles, long-range drones, bombs on energy and other civilian infrastructure, and a truce in the sea immediately if Russia will do the same. Is that enough for Donald Trump tonight to say that Zelensky is on an airplane and he's coming back to sign this deal?
We can never tell with Donald Trump, but clearly the ball is now in the Trump administration's court. It was in Vladimir Zelensky's court, and we understand that even Lindsey Graham helped put that statement together and gave it the old thumbs up, better days ahead after it went out. But we do have to see how the Trump administration responds to this. The reality is that we had just a few hours after the dust up is probably the best way to say it in the White House on Friday, we had the administration pause aid to Ukraine. I think they would like nothing more than to make that aid pause permanent. So now is he going to join again with Vladimir Zelensky in this mineral deal and release the aid again? I think we really have to wait and see. And of course, this is not just about the United States and Ukraine. It is also about Russia. That remains a huge question mark looming over all of this.
Well, I wanted to ask you about that because Bloomberg is reporting that Russia has agreed, Rick Davis, to assist President Trump's administration in communicating with Iran, reaching out to Iran on issues that include the nuclear program and its support for some of the proxies we've seen antagonizing and frequently attacking U.S. interests. Is this good news? Is this the kind of thing that Donald Trump will get Republicans on their feet over tonight?
That'll be one of the harder things to get Republicans out of their seat after years of berating Joe Biden's deal with the Iranians on nuclear weapons. To not have any details about what a deal would look like or whether there's even one possible, but to welcome Vladimir Putin as our deal partner in an effort. That's going to be tough to jump out of your seat and applaud. That being said, anything that gets nuclear weapons out of the hands of the Ayatollah is a good thing. And so if Vladimir Putin can help produce that, then I think we have to be cautious, but hopeful that something like that could actually benefit our negotiating position. So you can't rule it out just because it's Putin. And as they've said out of Moscow lately, Trump and Putin have a lot of alignment on where they see the world going. And maybe this is one way we can take a step back from nuclear annihilation at the hands of the Ayatollah.
Mm-hmm. Well, maybe they'll have some signs made up for this in the House chamber tonight. Jeannie, I don't know what Democrats are going to do with any of this, but what I'm reading is pretty wild. It's not just that they're going to be bringing special guests and made up of federal workers who've been laid off or others impacted by the work of the Doge. Politico says, get ready for the noisemakers. They're going to have props, noisemakers, signs with anti-Trump, anti-Doge messages, eggs. I don't know if we're throwing eggs, but empty egg cartons to get to the price of eggs here. I love pocket constitutions. I'll tell you, nothing will shut them down like that. But really, noisemakers, Jeannie, we're in for quite a ride if that's the case.
We are gone are the tame days when, I think it was 2017 or maybe it was 2019 when the women all wore white. Gone are the days when it's just about how you dress or boycotting. If we do indeed see noisemakers, gosh, Joe Matthew, I hope nobody is throwing eggs, but I could see some eggs being raised. I, of course, am in favor of the pocket constitution. Never should travel without one, so that's okay. As long as they hold it off nicely. But this is where we are, and we know the Democratic leadership has been pushing hard against this. They have been urging their members not to become the story, not to take the sort of attention off of Donald Trump and everything that's gone on in the last 43 days. But it's hard for Democrats to do that because on the ground, Democrats are deeply, deeply concerned about what they're seeing in the last 6 to 7 weeks. That includes DOGE, that includes Ukraine. I mean, you can just go down the list. So to imagine that all of these members gathered together and nobody takes a stand to draw attention to that, I can't believe it. So I am just worried about what we're not thinking somebody might do, and that may be what we see.
Boy, I guess Joe Wilson is the OG at this point. Rick, when it comes to disrupting the State of the Union, I guess he was ahead of his time. But I do want to mention a headline that Donald Trump just put up on Truth Social, Rick, and it has to do with the tariffs, because surely he's going to talk about that tonight. He says, please explain to Governor Trudeau of Canada that when he puts on a retaliatory tariff on the U.S., of course they were announced earlier, our reciprocal tariff will immediately increase by a like amount. I'm bringing this up because you're looking at the reaction today on Wall Street, Rick, and we talked about it last evening on the program. We took a deep dive on the S&P 500. We've now round-tripped in the markets to where we were pre-election here. That's certainly not a look that Donald Trump likes. What does he say about that later?
Yeah, look, I'm sure that he's watching the markets, especially yesterday's cratering of the S&P, and is thinking, this is a bad report card, especially leading up to the big speech tonight. And yet he's not convinced that this has anything to do with his trade policies. When you hear him talk, he thinks trade policies are going to make America rich again, and that should have a beneficial impact on the markets. He hasn't been watching the flight to safety, and maybe those things don't care, that he doesn't care so much about them. But as far as he's concerned, the way to make America rich again is to put up these tariffs, charge foreign countries, we're not charging Americans, and get them to pay our bills and rebalance the trade deficit. And I don't think anything that anybody says, including the performance of the markets, is going to dissuade him of this. He's been talking about this for a long time, 20 years. And I think he's now seeing that he can actually, as president, flex this muscle without any Congress or lawsuits. I mean, everything else he's doing, he's either got to hit Congress or he's got to convince the judiciary to let him do it. And this is one where he gets full field running, and he's going to do that. And he's not intimidated by countries like China and Mexico, and he sure as heck isn't going to think that he's got to worry about Governor Trudeau in Canada, even though Trudeau's right. It's going to cost a lot of money for everybody in both Canada and the United States, and nothing really positive is going to come out of it. But look, I don't know. I mean, I imagine that tonight he's going to take a victory lap on the tariffs and say that this is what's making America financially stronger.
I think he's got a terminal. He posted on Truth Social. It's a screen grab of a New York Times story in black and gold. Interesting, Jeannie. There's a senator, a Democrat from Michigan, who's going to deliver the official response tonight. In our remaining moment, I'm giving you even less than that, I'm sorry. How does Senator Slotkin frame this when it comes to the impact on Michigan?
I think she frames it as what she ran on, which is the costs of goods, grocery stores, eggs, as we talked about, but avocados, oranges, tomatoes, everything, prices go up. Maybe she quotes Trudeau, Donald, you're a smart guy, but this is a dumb thing to do. And there's hardly a person outside that administration who disagrees with that.
Is it a win to quote Justin Trudeau tonight? I don't know. Jeannie and Rick will stay with us our second hour with our signature panel. And as I said, they're in for the long haul. Special coverage starts 8 p.m. Eastern time tonight. Kaylee Lyons will be here. Rick and Jeannie, myself. Anne-Marie Horduran will be in Statuary Hall on Capitol Hill with some special guests. You'll want to make sure to join us right here on Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Tariff Tuesday brings quick retaliation. Welcome to the fastest show in politics as Canada responds to 25% tariffs with its own levies just hours before President Trump delivers his address to Congress. I'm Joe Matthew alongside Kaylee Lyons in Washington. Welcome to the Tuesday edition, the early edition of Balance of Power. Kaylee, it's interesting. The markets don't seem to like this, but based on the most recent truth from Donald Trump, this could just keep on going.
Yeah, it certainly could. He seems to not like what he heard from Prime Minister Trudeau earlier today, who I would remind everyone said these tariffs were, quote, very dumb. And the president now saying on Truth Social that Governor Trudeau, once again referring to maybe the 51st state he would like to see, should be explained to. He says, please explain to Governor Trudeau of Canada that when he puts a retaliatory tariff on the U.S., our reciprocal tariff will immediately increase by a like amount, knowing reciprocal tariffs are slated for April 2nd. Right. And it begs the question, would that be an additional 25% on top of the 25% that is implemented as of today? How does this math work?
Great questions, and we would love answers. Maybe we'll hear them in the big speech tonight. It's slated to start just after 9 p.m. We'll have special coverage here. It's going to be a long day in Washington with a lot of news, and not just on tariffs. We're looking at Ukraine and so many other topics today. The market's not in a great mood while we're having this conversation.
Yeah, so we'll see how the president addresses the moves in the markets and how Americans are feeling about the economy when he addresses a joint session of Congress this evening. And we'll be speaking with one lawmaker who, of course, will be in the room for that. Republican Congressman Mike Alford of Missouri will join us in just a minute. But first, we begin with a check on the markets. Charlie Pellet has a look from New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. We are off session lows, but still a down day, a lot of red across the board here with the Dow, the S&P, NASDAQ all slumping. Stocks getting hammered as concerns about the impact of a trade war on the global economy spur a flight to short-term bonds, gold, and haven currencies. Here's where we stand. S&P right now down 75 at 57.74. That is a drop of 1.3%. We have got the Dow down 658, down 1.5%. The NASDAQ Composite Index down 138, down by about 0.7%. The 10-year at 4.16% with the 2-year now at 3.89%. Gold up $18 the ounce, up 0.7%, 29.11, and West Texas Intermediate crude down 0.5%, 68.06 on WTI. Bitcoin now unchanged on the day at 85,300. Among the names reporting earnings, Target and Best Buy, they are both warning consumers to expect higher prices as a direct result of the tariffs that President Trump has imposed on Mexico, Canada, and China. Shares of both companies, they are trading lower. Target down 4.2%. Best Buy especially hard hit today, down now by 13.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. And back we go to Washington. Balance of Power continues now. Once again, your hosts Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at the market reaction to Tariff Tuesday. Thank you so much, because indeed that is what today turned out to be. Obviously, Joe, there was much question as to whether or not the president of the United States would carry through on his threat to impose higher tariffs on China, now at 20%, and of course 25% tariffs on Canada and Mexico. But to be fair, when speaking at the White House yesterday, he did say the deadline of midnight is not going to see a deal done before it. This is happening, and indeed it did.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariffs. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs.
No room left, he said, for Canada and Mexico. And so, as Kaylee mentioned, they took effect at midnight. Justin Trudeau, of course, Canada's prime minister, found room for retaliation, announcing his government would implement retaliatory tariffs, nearly $100 billion of imported U.S. goods. He didn't seem too happy when he addressed reporters earlier today. Listen.
There is absolutely no justification or need whatsoever for these tariffs today. Now, the legal pretext your government is using to bring in these tariffs is that Canada is apparently unwilling to help in the fight against illegal fentanyl. Well, that is totally false.
Donald Trump saying, please explain to Governor Trudeau of Canada that when he puts on a retaliatory tariff on the U.S., our reciprocal tariff will immediately increase by a like amount. So this is suddenly getting bigger before our eyes here, and it's where we start our conversation with Sean Donnan, Bloomberg senior writer for economics, has been far ahead in his journalism looking at the impact of tariffs and where they could hit hardest here in the U.S. Sean, it's great to see you. Welcome back. as always here. I guess we're not here to talk about the best stuff today, but I'm curious your thoughts when you hear this conversation, because it is happening. And what we heard from Howard Lutnick, the Commerce Secretary, this morning is this is a drug war, not a trade war. That doesn't start till April 2nd, but the financial markets don't seem to be waiting.
Well, I think what the financial markets are latching on to today is something that's been building for a few weeks, and that is we've seen nervous consumers out there already about inflation that's hanging around, and a lot of nerves about today that are coming into play about growth in the U.S. economy. I mean, we are going to see, we heard it from Target, we heard it from Best Buy, but we've been hearing it from other companies all along that they think they will see slower growth, slower demand as a result of these tariffs, and that is going to hit the overall U.S. economy. And if what we're looking at now is, and you hear that from the interplay between Justin Trudeau and Donald Trump today, we're looking at a tit-for-tat escalation. This is a broader trade war, and it's a trade war in North America among countries that are supposed to be allies that have benefited from each other for decades now.
Well, what the administration would say, at least we've heard this from the president, has been defended by others close to him, is that other countries will be paying these levies, that it's not ultimately to American consumers. And to the extent that these higher prices are actually passed on to consumers, it's a one-time price adjustment. This is not going to be something persistently inflationary. Is that true, though, Sean, if we're now talking about leveling up even existing tariffs at a later date?
No. So, I mean, it's very clear. When U.S. goods, when imported goods land at U.S. ports, the people paying the tariffs, literally writing the checks, are importers. Those are U.S. companies, and they tend, and this is what economic studies have shown over and over again, they tend to pass those costs, or a significant portion of those costs, on to consumers. So, you know, tariffs are a tax on imports, and that is a tax that is paid by U.S. companies and consumers, and we're going to see that hit the economy again. I mean, Howard Lutnick last week was talking about raising up to $700 billion in taxes, in tariff revenue, just from these reciprocal tariffs that haven't been introduced yet. These tariffs, the 25% tariffs on Canadian and Mexican imports and the 20% tariffs on Chinese goods, are going to raise hundreds of $billions more. Those are all going to be costs that are borne by U.S. businesses and consumers, and that's going to hit the economy. The other thing that hits the economy is just the higher cost of doing business from tariffs. If I'm a manufacturer in America today, I rely on a lot of imported components and so on. Those components today cost more than they did yesterday.
Just lastly, before we talk to Congressman Mark Alford about this, we're talking about Canada because we've heard about their retaliation. Sunday is when we'll hear from Mexico. Claudia Sheinbaum says her retaliation will be spelled out. She said she had a plan B, a C, and a D. What are we in for from Mexico?
Look, I mean, one of the things that is really in play and is going to be hit hard here is the auto sector, right? We import cars from Mexico. We import auto parts from Mexico. We also export auto parts to Mexico that go into a lot of those cars that come back in. If those are then hit by tariffs on the Mexican side, it's just going to raise the costs even more than these U.S. tariffs are. And, you know, we'll see how it escalates. If we move from plan A to B to C to D as things escalate, the damage is just only going to grow.
All right, Sean Donnan, Bloomberg senior writer for economics, here with us as we digest all of this tariff news. Thank you so much. Joining us here on Balance of Power on Bloomberg TV and radio. And joining us now on the program live from Capitol Hill is Republican Congressman Mark Alford of Missouri, who sits on the Small Business Committee. Congressman, welcome back to Bloomberg. It's good to have you, sir. When you consider what small businesses may be thinking today in the face of news of these tariffs, wondering what will happen to the costs they are facing and their ability to pass those costs on to the people who purchase goods and services from them, what would you tell them?
Interesting you should bring up small business. We just had a meeting with a new administrator, Senator Kelly Loeffler, who is intent on getting small business representatives into the rural parts of America. In particular, we requested that in our district just south of Kansas City. And I'll tell you what our small business owners are saying. Look, we know that there are going to be some price increases that they're going to have to pass on to consumers, but it is worth it if we can save 100,000 lives a year through the fentanyl poisoning. This past administration, the Biden administration, with the porous borders, we're allowing this fentanyl poison to come up and this toxins to poison and kill our young people. And so, look, we get stuff delivered to our house just about every day, it seems like, from Amazon. And typically cheap goods, immediate gratification from China. I'm willing to pay a little bit more if we can stop the poisoning, particularly of our young people, that's coming through Canada and Mexico.
Well, that's really interesting, Congressman. We appreciate that firsthand account. If small business owners are telling you that, then they are prepared for some short-term pain, as Donald Trump had previously warned.
Look, I think small businesses got kind of the short-sheeted with this past administration. They have not gotten the capital and counseling that they need from the Small Business Administration. It seems like Administrator Guzman was more concerned about registering Democrat voters than actually getting out with representatives and helping small businesses grow. Kelly Loeffler is changing that, and we are going to make sure that small businesses thrive. Part of that is going to be building small businesses in the rural area. We're intent on doing that. I know that these tariffs might be a temporary setback, but it is a short-term pain for a long-term gain for America. Reciprocal tariffs are what I think that we need to right the ship in America, to gain the respect on the world stage, and Donald Trump is going to do that with my support and the Republican conference.
Well, I do wonder how long-term is the term we're actually talking about here, Congressman, because the president was elected to a 4-year term off the back of concerns voters had about the economy. And if you look at polls that we've consistently seen in the last several weeks, they are concerned he's not doing enough to address the prices they are facing now, let alone what they might face in the future once you account for the impact of tariffs. What does he need to say about that tonight when he addresses you and your colleagues?
I think he's going to talk about his wins already, opening up oil production in America, shutting down the border, essentially securing our border with more than 90% reduction in illegal crossings into our great nation. That puts such a strain on the fabric of America. And I think that some of the other wins that he has is going to go a long way to bringing down the interest rates in America, restoring. If we can get this Tax Cuts and Jobs Act passed through the House Reconciliation and the Senate Reconciliation Bill, that will go a long way to restoring confidence in the bond market, and in turn, I believe the Federal Reserve will bring down the interest rates. I am the chair of the Real Estate Caucus. We just had a meeting, heard from young people here on Capitol Hill who want to buy a home and they can't because of supply shortages, because of over-regulation, Inflation Reduction Act regulations, climate regulations that are driving some home builders out of business. They can't keep up with these regulations. It's adding 25% to the cost of a home in Kansas City. I firmly believe that the economic policies that Donald J. Trump is instilling now is going to turn our economy around in a short order within the next 2 quarters and get our economy juiced again to where we're not going to have to worry about these reciprocal tariffs.
So if the cost of goods, though, continues to rise across the board, and we're looking at now the potential for a trade war, in the words of Howard Lutnick, to begin on April 2nd, how does that help to get more young people in affordable homes?
Well, we raise salaries. I think you're going to see that coming. The demand for intellect, the demand for good labor is there. And so our workforce, if we provide the education they need and the training they need for skilled labor, I'm big on that in our district, they're going to have good paying jobs and they're going to be able to afford not the hyperinflation that Joe Biden brought about, but I think a reasonable rate of inflation that we can all live with a higher salary, higher earning power, and higher confidence in the American economy.
I do wonder about a potential wage price spiral that could stem from that, Congressman, if people are constantly having to demand more from their employers so that they can afford the cost of goods, and that buying power only continues to drive the cost of goods higher. But when we're considering people who have jobs or maybe negotiating their wages, of course, there are now thousands of federal workers who no longer do, given the efforts of the Department of Government Efficiency. I know you had a town hall last week and you had to answer some questions about those layoffs and the spending cuts. Is this making your job and your communication with your constituents harder, if not the concept of reducing the federal government, but the way in which this has been done?
I love talking to our constituents, Democrats, Republicans, independent, politically agnostic. I represent 772,047 individuals. We give the same level of concierge service in our 3 offices in our district. But look, you've got to have a conversation. I want to have a give and take with the constituents. We had a lot of people show up at this. It was really supposed to be a coffee. Usually I have 10 people show up. There was almost 200. I had everyone write down their question on index cards. I read the question, and then when I started answering, they would try to shout me down. That is not an exchange of ideas. That is not answering questions. I want to listen to people, but I also want to have a discussion. And that's not happening now because of organized disruptors who are trying to make what we do ineffective. And that is not right for our constituents who really want to have discussions.
There's talk about organized disruptors on the other side of your aisle tonight. Congressmen, Democrats may be bringing props, signs, even noisemakers, according to some reports. What will be the decorum in the hall later?
Well, decorum is a very big part of the Republican conference. We will maintain decorum. I have no control over what the
Republicans were doing a lot of yelling last year at Joe Biden.
Well, there were some, but I think the vast majority of the Republican conference, including myself, were treating the office of the presidency with respect. And I would encourage all members, Republicans or Democrats, to do the same. Because, listen, this is a chance for the chief executive to come in, although technically this is not a State of the Union address. It's a chance to hear what's on the president's heart, soul, and mind. And then for us as Congress, a body, to work together where we can to bring about positive change for America. I think the president, again, whether it's Joe Biden or whether it's Donald J. Trump, President Obama, President Clinton, George W. Bush, or Ronald Reagan, if you're standing up there as a chief executive, you deserve to be heard, and we deserve to give our respect to that office.
In our final moment together, Congressman, as you talk about working together where you can, is one of those areas going to be keeping the government funded beyond 10 days from now? How will a shutdown be averted?
Well, I certainly hope so. I was with the chairman of the Appropriations Committee, Tom Cole, yesterday. I'm now in the Appropriations Committee, and we were talking about that. He has tried in earnest to work with his counterparts in the House and in the Senate to keep the government open by passing the 2025. Yes, we're still trying to pass the 2025 budget. We're a year behind, and they reached a top-line number, but they wanted to hobble the president and Elon Musk and Doge from doing their job of weeding out waste, abuse, and fraud in the government and finding these savings, reasonable savings for America. And we're just not willing to do that. Tom Cole, the appropriations chair, is not willing to do that. He did not walk away from negotiating. That is something that the Democrats put out there to try to win people over. I'm thinking now, and I think Senator Schumer put out a statement on social media today that they might be going for a shutdown. And if they do, that is a Schumer shutdown. We, under the direction of our leadership, I think are going to move towards a continuing resolution that will fund the government to the end of September. Let's finish out September.
Keeping in mind Republicans do control both houses. It's great to have you back. Mark Alford, Republican from Missouri. As we look ahead to the speech tonight, we'll assemble our panel next right here on Bloomberg.
9:21 on Wall Street. We do check markets all day long here at Bloomberg. Trump tariffs take effect. Stocks are getting hammered across the board. Right to the numbers. We're off session lows, but still a 54-point drop in the S&P 500 index to 5796, down by about 0.9%. The Dow now lower by 520, down 1.2%. Nasdaq down 43. That is a drop of 0.2%. The 10-year 4.18%, with the 2-year 3.92%. Spot gold up $20 the ounce, up 0.7%. The precious metal now at $29.12 the ounce. West Texas Intermediate crude down 0.1%. WTI 68.25 a barrel. Brent 71.06, and Bitcoin up now by 0.4%. 85,617 on Bitcoin. Honeywell International is paying $2.16 billion in cash to purchase Sundyne. That is a maker of pumps and compressors owned by the private equity firm Warburg Pincus. Honeywell shares lower today by 1.4%. Recapping stocks lower, with the S&P 500 index now down by 1%, the 10-year 4.18%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you very much. Checking on the S&P 500 at levels that we haven't seen since November 5th, 2024. And I seem to believe, Joe, that something pretty important was happening on that day. That was, in fact, Election Day.
Yes, indeed.
When, of course, Donald Trump was overwhelmingly, by Electoral College standards and the popular vote, elected president of the United States. And in doing so, helped precipitate what had been a pretty remarkable market rally, with the S&P 500 as recently as a few weeks ago at record highs, something he touted when speaking at the Saudi Investment Forum, FII, in Florida just earlier this month. And now here we are back at levels from before we knew that it was Donald Trump who would be the next president of the United States. And I can't imagine that is sitting extraordinarily well with him as he gets prepared to address the nation in a joint session of Congress this evening at the Capitol.
Yeah, that prompted a big old rally, as we saw following the election. To think that we have done a round trip like this and so quickly, so precipitously, is certainly freaking out a lot of investors. As we watch the markets here, it's kind of turned into a split screen once again. If you remember Donald Trump, toward the end of his first term, every day he'd be out speaking about, remember, it was COVID. There'd typically be an update on COVID, on vaccines and so forth, and there'd be a split screen on every cable news screen with the financial markets. And we may be back in a world like that, as indeed the president addresses Congress later. And it's where we start our conversation with our signature panel. They're in for the long haul today. Rick and Jeannie with us right now. Rick Davis, partner at Stone Court Capital, Republican strategist, and Jeannie Shanzano, our Democratic analyst and senior democracy fellow with the Center for the Study of the Presidency and Congress. What's your thought on that, Jeannie, knowing that Donald Trump thinks that the stock market is really the ultimate metric when it comes to his success? And the split screen, even if implied, as he addresses Congress and the American people tonight, means what?
Yeah, I mean, rationally, you would think he looks at these numbers and sees all that red and says, gosh, I didn't mean about those tariffs. Let's go back and pull back on that. Because the stunning thing about this is the gains that were made, as you guys were just talking about, have all been lost. And this is a self-inflicted wound. This was not a natural disaster. It is not some kind of calamity that has befallen like so many presidents have dealt with. He has done this to himself and to the economy so far. You know, there is an old statement, civilizations decline when you forget what's obvious. And what's obvious that we know is tariffs are really, really bad for a good economy. Nobody outside of the administration, and probably a lot of people in the administration, disagrees with that. And so why he is doing this, and if he keeps it up given these numbers, I just can't imagine that he will. But so far, he is all in.
Well, Rick, we often hear said and say it ourselves at Bloomberg that the stock market is not the economy, that fundamentally they are very different things. And yet it does seem what the stock market is reflecting, at least right now, is concern about the economy. So I do wonder what your take is on how Donald Trump is going to speak about this evening, not just thinking of like where asset prices actually are, but what it is signaling about what his policies may do to what everyday Americans are experiencing when they go to the grocery store or just take a look at their bills.
Yeah, I think he's going to double down on this notion that he can reverse the current course of a general economic slowdown and ramp it up. He's got a little bit of success to talk about around oil prices, gas pumps, but he's not going to let facts get in the way of a good story, right? So, he's going to talk about how already the country is moving forward in a better economic direction, and there are some successes. Inflation's been held down, and so on those things that is positive, he'll take full credit for that. And for all those negative things, I think they'll be in the basket of Joe Biden problems that he inherited. And I think Joe Biden will show up quite a bit in the speech. He's been sort of going back to his campaign rhetoric recently and using Joe Biden as the person that caused all this havoc in the United States. And I wouldn't be surprised that all these things that are negative related to the economy are going to be Biden problems that he inherited.
Does he speak, Rick, maybe to the temporary pain that he referred to at one point, the way Mark Alford just did a moment ago, that this is about something bigger than the stock market or making money, that he's trying to save American lives by stopping fentanyl at the border?
Yeah, there's no question fentanyl will be the reason that these punitive tariffs have been put on Mexico, China, and Canada. I mean, honestly, the broad brush on this is awful hard to swallow. I mean, Canada is not the reason millions of people or hundreds of thousands of people have been dying from fentanyl, and yet they get tarred with the same brush as people who have been a part of the poorest problem, and that's Mexico and China. So I did see, though, that the China retaliatory tariffs that went into effect kind of mimic that. They're blaming bark beetles for banning our lumber and soybean fungi for the reason that they're going to raise tariffs on soybeans. I mean, they're not saying these are retaliatory tariffs. They're saying, oh, we've got defective products. And so this whole tariff war, is turning into the sort of level of sublime idiocy. I mean, like, we're going to start blaming things on beetles and fungi and not really addressing the current problem. So I don't think Donald Trump is going to shy away from both the economic argument. These countries have been living off of our trade surpluses and living off of our trade deficit. And in the meantime, they've also been hurting our country. So he's going to unload both barrels tonight. I have no doubt about that.
Well, and to Rick's point on Canada, as we're hearing this administration frame it not as a trade war, but as a drug war, according to Customs and Border Patrol data, the amount of fentanyl that crossed the Canadian border last year was just 43 pounds compared to the 21,000 pounds that crossed over the southern border. So we should just bear those facts in mind as we consider not just only the justification for these tariffs that the president is using, but also the way in which it will inform what moves forward. Because, Jeannie, if these tariffs are ever to be taken lower, presumably it would be because he sees some progress. Have we yet seen defined what kind of progress he is looking for? What is going to be enough for him to say, all right, now you've done what I asked. Here go the tariffs. I'm taking them down.
So far, we have not seen that. And if they're going to continue, as Howard Lutnick said, that this is, and we're talking about fentanyl, this is a drug war, not a trade war. How much lower could Canada go in terms of fentanyl? They are just 1% of the fentanyl intercepted at the U.S. border. You don't get much better than that. I mean, certainly we'd all like it to be zero, but that is not the problem. But they're saying that's the problem. So how does Canada repair that? There's no way to go. And this gives lie to what they have been talking about. Donald Trump seems to be responding to a huge real challenge, and that is the loss of manufacturing, many decades in the making. But he is not going to be able to repair that with a trade war against our closest allies without real pain. And I think in your great conversation with the congressman, we just heard how difficult it is going to be for members of Congress to defend that to their constituencies. I mean, we even heard Ron Johnson, a fairly conservative, very conservative guy, say his state is going to feel pain as it pertains to agriculture and manufacturing. as a result of this trade war. There is a no win here, and Donald Trump is not the kind of politician who's going to stand up and say, we're going to take short-term pain for long-term gain. I don't see him doing that, and he can try to blame Biden. I'm sure Rick is right, he will. But the reality is this is a self-inflicted Donald Trump wound, and it's a wound to him politically, and it's a wound to the economy and the market that he's going to have to turn around. I think he'll be able to do that, but he's got to look at what's happening and see the lie of what he has been believing so long, that you can correct the manufacturing decline in the U.S. by a trade war.
Rick, is all this going to make people want to watch? 32 million tuned in to see Joe Biden's last State of the Union in 2024. And you know that other than the stock market, I guess TV ratings are the closest thing to a metric of success for Donald Trump. How much show business do we have to consider here?
Well, he always gets the eyeballs, whether it was, in the days of Apprentice or in his own political career. So I have no doubt we could be breaking records tonight. Plus, the onslaught of his policies in the last 5 weeks is, unprecedented in Washington for a new administration. So I am pretty confident, based on just my own poll of talking to people I know, wondering, what's next? They're going to want to tune in and see what news he makes tonight, because it could impact you wherever you are.
Well, will as many people stick around for the Democratic response? Jeannie, it's going to be delivered by the new Democratic Senator Alyssa Slotkin of Michigan, was able to win her Senate seat in a state that Donald Trump carried in November. What is her message going to be?
I think her message is going to be about kitchen table issues. She proved she could win a state like Michigan that Donald Trump also won. She's got to show Democrats a path forward, which is appealing to people who split their ticket in 2024, because she focused like a laser beam on issues that they really care about, which are kitchen issues. But of course, Kaylee, she does not want to be in a kitchen. We saw that last year around. It's not going to go well. So I suspect she'll have another background for the speech tonight.
Yeah, perhaps not going to take a play out of Katie Britt's book. Jeannie Shanzano and Rick Davis, our signature political panel, with us on the early edition. They'll be with us on the late edition of Balance of Power, and of course, for our special coverage of this address. It begins at 8 p.m. Eastern Time right here on Bloomberg TV and radio. And who knows how long it will go for. The White House is saying that the president will be at the Capitol for more than 2 hours.
Yeah, 11:20, he could still be shaking hands and backslapping, and that's just the way these things go. Questions, too, about whether he might have a couple of meetings or more deliberate conversations with 10 days left till a funding deadline in the government. Interesting, you mentioned Senator Slotkin. The Premier of Ontario, Doug Ford, who had some pretty tough words for Donald Trump today, says he will add a 25% tax on electricity that goes to states, including Michigan.
Yeah, and he'll do so with a smile, right?
He said that, a smile on his face. He wasn't smiling when he said it, though.
Yeah. All right. We'll have more on the tariffs coming up in just a moment with someone who used to serve at the USTR in the last administration. That's just ahead on Balance of Power on Bloomberg TV and radio.
This is Balance of Power with Joe Matthew and Kaylee Lines on Bloomberg Radio and Television.
On Tariff Tuesday, thanks for being with us on the fastest show in politics. We're live in Washington, where President Trump will be addressing a joint session of Congress a bit after 9 p.m. Eastern Time. We'll have special coverage starting at 8 and hope you'll be with us. Our signature panel will be as well. Rick Davis and Jeannie Shanzano. As we consider the implementation of tariffs, Kaylee, on Canada and Mexico, we've already heard about retaliation from Canada, and Donald Trump says we'll just keep on reciprocating. It's an interesting moment, though, as the Commerce Secretary, Howard Lutnick, frames this as a drug war, suggesting that the trade war doesn't begin until April 2nd.
Well, and April 2nd is when we're expecting a laundry list of other tariffs to take effect. The reciprocal tariffs that President Trump was alluding to could impact Canada on top of what already has been imposed today. Auto tariffs are set to go into effect. He suggested Europe tariffs of 25% may be implemented in April as well. By all accounts, at least at this stage, the president is signaling things only go up from here in terms of the way in which the United States taxes imports. But what we are dealing with right now and what the market is contending with is the S&P 500 has now erased all gains it made in the aftermath of President Trump's election in November, is the reality that our three biggest trading partners now have tariffs of at least 20% on pretty much every good that comes for them, barring Canadian energy, which of course is at 10%.
S&P 500 now back below 5,800 today, Kaylee. Yesterday was the biggest loss of the year for the S&P. The VIX is rising, and the market wants to know what's next. Maybe we'll learn tonight.
Well, yes, I'm imagining we're going to get a lot more of this from the president's speech. And as we look ahead to that and consider the impact of this policy, we turn to Greta Peiss. She is partner at Wiley Ryan and former general counsel for the Office of the United States Trade Representative. She's been dealing with trade issues for many, many years. Greta, thanks for joining us here on Balance of Power. When we consider this notion of things getting ratcheted up further, reciprocal tariffs going into place in just a few weeks, is it your expectation that countries in advance of that may actually lower their tariff rates so that they don't face as high a levy from the United States, or is this just going to raise the cost of everything?
Thank you for having me. I think we don't know. I wouldn't expect countries to preemptively lower their tariffs. I think because of some uncertainty as to what exactly those reciprocal tariffs will look like, what they will count, and how they'll be implemented. And so if countries were to lower their tariffs today before those actions were taken, it would really be negotiating against themselves and trying to predict something that's just unpredictable right now. They don't know exactly what will come out of the Trump administration and those reciprocal tariff actions that they've discussed.
Well, it'll be interesting to hear how Donald Trump frames this tonight. We've heard a lot about temporary pain, that this will be the cost of saving lives. Greta, when the flow of fentanyl is stopped at our northern and southern borders, how temporary would that pain be before the rest of Donald Trump's policies, presuming that things are all passed and codified on Capitol Hill, are put into effect?
Well, we don't know, in part because we don't know what the asks are on the fentanyl and immigration side. We haven't seen a lot of news come out about the negotiations with Canada and Mexico and what specifically the Trump administration is asking in order to resolve these crises and make a dent on the fentanyl and immigration issues. And then, of course, there is the question of what comes next with respect to reciprocal tariffs and other actions that have either started or have been discussed. And so I think the name of the game for these trading partners and for businesses across the border is uncertainty about what the future holds.
Yeah. Well, just to follow up on that quickly, we heard from the Commerce Secretary, Howard Lutnick, this morning. He said that we need to see material reduction in autopsy deaths from opioids. That is apparently the metric. Based on your experience working with the USTR, how is that made clear, and how can our partners reach a goal like that?
Well, my experience at the U.S. Trade Representative Office, doesn't really shed light onto this, because this is really breaking new ground for this administration. They're using new authorities with a new rationale in the trade space, sort of crossing over between what we normally think of as law enforcement issues, public health issues, and tying them to trade tools. And in this case, it's a question how, what's tied directly to our trade relationships with Canada and Mexico, and what may not be. And so, that, again, it just raises a question of how, as you put it, how do you measure? What's the outcome? How do you know that this is successful in addressing these issues? And what are the actions that they're really looking for here?
Well, I'm glad, Greta, that you raise the authorities with which the president is taking this action. We've heard both Canada, through Justin Trudeau, the prime minister, as well as China, suggest that they will be challenging these measures at the World Trade Organization. Could this be overturned through that mechanism? How binding would any WTO findings be? Is there a question around whether President Trump actually has the ability to continue enforcing this?
So yes, I saw the statements around WTO action. At this stage, bringing claims at the World Trade Organization, in some respects, it's symbolic. What the World Trade Organization does through dispute settlement is give trading partners the sort of green light to retaliate for trade actions. Canada is already moving forward with its retaliation. Mexico's doing so as well. So you can see that they're not waiting for those outcomes. They may still go ahead at the WTO to make the point that, in their view, these are inconsistent. The Trump administration may have arguments that there's exceptions that allow them to take this type of action, and we'll have to see how that plays out.
As we spend time with Greta, I want to remind our viewers and listeners we have an important conversation on the way from Bloomberg Invest with Gary Cohn, Vice Chair of IBM. We're only a couple of minutes away from that. I'd be curious to hear his take on this, Greta. And I want to tap your experience on Capitol Hill, because you are also Senior International Trade Counsel for the U.S. Senate Committee on Finance. And among the legislation that you helped to craft and implement was the Miscellaneous Tariff Bill Act of 2018. Now, you must be smirking a little bit, knowing that the aim of that legislation was to reduce or eliminate tariffs on imported goods. Will lawmakers have any role in this? Will there be any legislation surrounding the implementation of these tariffs, or is this all Donald Trump all the time?
Well, I think the current assessment with this Congress is that it's unlikely they'll be doing anything legislatively to alter the course. It is very difficult to pass trade legislation. They would need to do so on a bipartisan basis, overcoming a potential veto from the president. I think that said, members of Congress will hear rising and continuing concerns from constituents, businesses, exporters, importers, potentially consumers, as these tariffs go into place and as they increase. And that political pressure will start to influence members and, by extension, the White House, potentially.
Well, the White House doesn't seem too influenced by any particular political pressure at this time, as it is standing by its policies here. Also keeping in mind, Greta, that they see this as a means to raise revenue. With the tariff levels on this quantity of imports that we're dealing with now, $1.5 trillion worth from our three largest trading partners, with the potential for reciprocal tariffs, with the Commerce Secretary suggesting that could be another several $100 billion raised. How does this mathematically work when looking at what it's going to do to the coffers of the United States Treasury?
Well, certainly it will increase the tariff revenue. You have to, when you're estimating out the revenue collection from tariffs, you have to take into account the fact that imports will likely go down. So it's not going to be 25% on the current level of trade continuing forever, because presumably the current level of imports will go down as those imports become more expensive. And I think that that's part of the objectives that the administration is looking for. So it will be a revenue raiser. I think it's a question of, do the tariffs stay in place in their current form? Is the administration able to maintain that politically? And will the trade stay at this level, or will it decrease in a way that really diminishes the amount of tariff collection that results?
I know it's all about Canada today, Greta, but I am interested that no one's talking about China very much. Donald Trump said he didn't expect Beijing to retaliate too much, were his words, but we've got quite the retaliation, up to 15% on a bunch of farm products here, including soybeans, meat, and grains. Are food prices going up?
Well, we'll see. It's interesting because China did take strong retaliation, but of course, compared to what the tariffs have been put in place so far, I mean, we've put in place tariffs now just in this most recent action on over $400 billion worth of imports. And China is retaliating with targeted tariffs on key agricultural products in the tens of billions, right? But with real impact on those sectors. That will cause pain in certain congressional districts in certain parts of the country. It will be another cost of this policy.
All right, Greta, thank you so much for the time. We bring you now to that special conversation that we mentioned at Bloomberg Invest. Gary Cohn, Vice Chair IBM, and Bloomberg's Matt Miller. Let's watch and listen live.
AI we have right now. During that period of time, you had to pre-program a huge database with all of the answers because we didn't have the real-time connectivity to the data around the world. Today, if you were going to play Jeopardy, you would completely do it differently. You would just allow the AI machine to go get the answer instantaneously. 40 years ago, you had to sort of put the answers in a room and hope that Jeopardy asked the questions in the categories you wanted. It was easier to program all the chess moves. Today, you know, AI has evolved dramatically, and I think we're all living through this, I would say, evolution. I'm not sure it's a revolution, evolution of AI. You know, we've gone from the concept, and if you look at sort of CEO surveys or corporate surveys, you know, a year or two ago, I think it was about 90% of CEOs said they, you know, clearly were going to be involved and use AI. And of those 90%, less than 10% could actually tell you what they were going to use it for. They just felt like they needed to talk about using it. Today, I think the amount of CEOs that are using AI continues to grow, but more importantly, they actually know what they're going to use it for. And the definitional outcomes of where AI can enhance your business is becoming clearer. That's where they are today. I think it's going to continue to evolve to where you can use AI in your business and where the paybacks are and how you create real productivity growth. I won't geek out on productivity growth, but at the end of the day, you know, if you want to grow GDP and you want to grow your economy, it is all about getting more productivity, getting more units of work out of your labor force.
So I think about this a lot in a competitive sense. If you're a big business and you haven't figured out how you're going to use AI yet, are you too late? Have you lost out?
You're never too late. You're never too late. You know, what you may be late is you may be at a competitive disadvantage to your nearest competitor because they may be able to do certain things more efficiently than you, but you can catch up quickly. So you're not that far behind. So you have to sort of figure out where the opportunities are in your business, and it depends on size, scope, scale of your business. So like a very obvious place where in a bigger company, and this is something we did at IBM and we've talked about it, we like being client zero for all of our products. You know, we did something relatively simple. It sounds simple, but it was not that simple. An HR chatbot. You think of what most people use HR for after the day one hiring experience. 90% of what they want is, you know, they go buy an apartment, they go rent an apartment, they need a reference letter. They need a reference letter. What day did I start working? How long have I worked here? What was my last year's compensation? What was my bonus? And you want that sent like that minute. And, you know, in a year or two ago, you used to call someone in HR, you used to give them the information, you used to tell them where you want it sent, and you hope and pray they sent it out quickly. Today, you're at IBM, you would type it into a HR chatbot, and the minute you said hit send, the letter will go out. So people are actually very happy. Oh my God, I get what I want. I get all this information. You have information about your benefit, information about your healthcare. We do it all real time. We cut 600 people out of our HR department. Now, we didn't fire them. We redeployed them to places where they can be more useful. And our satisfaction scores for our employees using HR has gone up dramatically because they get real-time answers. So it depends what you're trying to achieve in your company. You know, there's a lot of people using AI today in code assist, in writing new code. So if you're in a big code writing shop or writing new code is important to you, and you're at a disadvantage because your competitors are using a code assist program and you're not, you're at a competitive disadvantage. You take a lot of people here in the financial services industry. Most banks happen to know what banks do. Most banks historically built a technology infrastructure on a sort of as-needed basis. And if you go pull back the covers, they've got lots of different systems in a variety of different languages. And when you try and integrate them and have them talk to each other, it's very difficult. So every bank during the course of the last decade or 20 years tried to think, how do I get all of my software? How do I get all my systems on a common language? It was an arduous task that was cost prohibitive. Today, it's not cost prohibitive. Today, you can get a code assist bot to basically port one language over to another language, and it's pretty flawless in how it happens. So there's a lot of places evolving today where AI is very useful, and it depends on your particular circumstance.
I want to ask you about the cost, because I think the reason it was so daunting in my mind, especially for a information technology company, is I was looking at OpenAI and thinking, you've got to invest $100 billion to create a large language model, and only a few of these giant hyperscalers in Silicon Valley can do it. Now, obviously, DeepSeek, although there are questions about how exactly they did it and how much it costs, shows that you can do it for far less.
Well, thank you to the Chinese DeepSeek for proving out what a lot of us knew in this country, but no one wanted to listen to. So if you look at what we've been doing at IBM, you look at what Meta's been doing, you look at what a lot of companies here in the United States have been doing, we've been building small models. What we have found, and DeepSeek sort of proved this out, the small models are much more efficient, they compute faster, they take less power, but they're not a model that can do everything. They're sort of targeted models. So the things that I was talking to you about, we have small models that are used for specific targeted goals. I think that is the future. We think that is the future of AI. We think most companies will engage with as many small models as they need to get done what they need to get done where they're using AI, and it will be vastly more efficient, vastly more cost effective for them. And I think this is the future where we're going. Look, will there be some large language models out there that are effective? Yes, but they will sort of be the catch-all models for everything.
So, it still costs a lot of money to invest. I think Moody's estimated it's going to be $2 billion in investment over the next 5 years, which doesn't seem that far off when I look at the CapEx plans of these Mag 7 companies. You and I both lived through the internet bubble and watched so many companies put money into laying down fiber cable and build the infrastructure, the data centers of Web 1.0, for a lot of CapEx when they weren't getting a lot of return on investment, at least not for years, if they ever did. Do you see real parallels here?
Yeah, yes. Look, as you're building technological infrastructure and backbone, you're building it based on what's available today and what you know today. The whole AI backbone, infrastructure, compute, technology, it's moving very fast. But you can't wait for version 2.0 or version 3.0 or version 4.0. You have to build based on what's available today. What's available today will be obsolete, a lot of it before it gets built, and it will get replaced by newer and newer versions. So there is a bunch of money being spent today that will have very low returns to no returns. But if you don't start investing, you'll never start. So you sort of have this prisoner's dilemma that I have to start building this data center, and I think I'm going to be putting XYZ chip in, but by the way it gets built in 2 years, I may not be putting, I most likely will not be putting that chip in. And the amount of power I think I need to run that data center may be dramatically less, because the next chip, I bet, is going to be a lot more efficient than the chip we have today. So a lot of this build, you can't wait for the efficient frontier because someone's always going to be out there. You have to keep building, and there will be a lot of waste to get there. I just think it's inevitable. And then, these AI models themselves are going to build upon themselves, and they're going to get smarter and smarter, and they're going to optimize and re-optimize, and everything's going to get better and faster and quicker. And ultimately, the AI of the data center is going to tell you how to build better data center, how to build better connectivity, how to optimize the optimization.
What do you do though as an investor? I mean, you know, as an IBM or as a Microsoft, or as you point out, they don't have any choice. They've got to build now. But what do you do as a private investor? What do you do as someone who's looking at markets? How do you analyze that?
Well, it's interesting. If you look at the history, and the history of technology is not that old. And if you look at, you know, sort of what's going on here, you know, ultimately the bigger companies are going to have a real big impact in this. Now, it's really, and then I'll point out that all the bigger companies that we talk about today, whether it be the Metas or the Googles, you know, I remember when Facebook started, it was a really small company. And I'm not that old. I'm old enough, but I'm not that old. So all these big companies, I remind people, start out as really small companies. So there are a bunch of small companies today that are going to be really big companies unless in that path, one of these bigger companies can buy them out. You know, we've now got companies that can go spend $100 billion and buy out a company, you know, relatively easily today. So if you were looking at what you think is the most likely path, I think the most likely path is the big, I don't know if it's the Mag 7, but the bigger companies who are spending the most in CapEx are the most likely winners. And they will, you know, many of them will fund some of these startups. And almost all of the big companies have huge venture arms because they're trying to spend money in these startups. They're trying to get opportunities to let creative people create. And then as those products become really valuable, they're just going to buy them and merge them into the bigger companies. So, you know, I guess my investment advice is, look, you can own some of these small companies, and most of them are private, and they're probably interesting to own a portfolio of them. But if you ask me where I think this is going to be a decade from now, I think the bigger companies are going to dominate the space.
Is that part of what you're doing at IBM? I mean, do you help Arvind Krishna maybe zone in on some targets?
We definitely have a ventures portfolio for something that's on the cutting edge that fits within our parameters, you know, whether it's hybrid cloud, open AI, quantum, you know, but we're very much in the open source, so we're going to buy open source companies. If it fits within our parameters and we think it's got an interesting opportunity, it's in our shareholders' best interest for us to get involved in the company early, not late.
By the way, a little bit detached from the specific AI conversation, what do you think about the M&A landscape right now? When we came into this year, me and Shonali and Katie were joking about an opinion writer who said maybe there won't be that many deals because everybody said this is going to be the year, you know, that the regulators drop their guard and everybody can get together. Now it's starting to look like that may not be the case.
Well, that was the total market euphoria from November election to January 20th. Was deregulation, ease of doing business, the FTC, the CFTC, the SEC, everything C is going to get easier and be much more pro-business. And we're going to have, you know, this huge influx, this huge massive explosion of deals, of M&A deals, of IPO deals. Look, we're 45 or 46 days into this. I don't want to judge this book by its cover, but the first 45 days, we've not had an explosion of deals. In fact, probably based on what's going on in markets right now, market multiples, we've probably lost deals. So I would say the calendar from January 20 to today is smaller than it was. That's not a regulatory statement, that's a valuation statement. And you also have to be reminded that some of these commissioners are not in place, heads of SEC, even the FTC doesn't have a full Republican slate. It's got 2 Republicans, 2 Democrats, so it's hard to get things through on a 2-2. These things take more time. So I think some of that euphoria is still there, but I think more people are taking the approach of, okay, you're going to have to show me it's a different environment than just trust me. I think we've gone from trust me to show me.
I want to get back to regulation in a minute as it pertains to AI, but you mentioned productivity. You don't want to geek out on it. We haven't seen much of an impact yet from AI on productivity. I actually have chatbot now open next to my Bloomberg screens every morning.
Does it make you more productive?
I'm actually getting a lot more detail into my newscast than I would otherwise. I use it as more of a glorified search, but we haven't really seen it boost the numbers economically. And I wonder, when you think we're going to see that, and if it's going to actually have an effect on jobs. You mentioned that you've moved HR people out because you can replace them in that role with AI. Yep. Are we going to see, an uptick in or a loss in non-farm payrolls because of it?
So we've also created, artificial workers. So we now can create artificial workers in certain way. In our consulting business, we now have artificial workers who, will work 24-hour days, which is kind of nice.
Just like Doge.
Yeah. So I don't know if I'm going to make that. You made that comparison. I will not own that comparison. So let's talk about your question. I think your question is, if AI is going to be successful, are we going to see a real impact to labor and employment numbers around the world, let alone in the United States? Yeah. So my pretty bold answer is, and I always say this to rooms full of people like this, who usually first question I get is, isn't this devastating to the economy? I say, look, I'll give you the rest of the time I'm up here, which is very short at this point, so it's not a lot of time. I'll give you the rest of the time I'm up here to come up with a major technological advancement that destroyed jobs. And you can go back and you can take anyone you want. And so, let's just take the internal combustion engine. That was supposed to destroy jobs because all those people that cleaned stalls and put shoes on horses, they were going to all lose their jobs. Well, but all of a sudden, the next day, when we started putting internal combustion engines on the streets, we needed mechanics, we needed gas stations, we needed different skill sets, different people. But all of a sudden, there were more jobs created because people could go 50 miles a day or 100 miles a day versus 2 miles a day. So their landscape, their business model expanded. It's no different than when the internet, I worked at a bank before we had email. We used to have, every floor had a person that printed the memos and put it in your mailbox and told you what time the meeting was or told you what time to go. What happened to that person who delivered the mail on the floor and printed the memos? They sort of disappeared overnight. Now, we didn't have less people. In fact, every bank, I guarantee you, since the invention of email, is double its size. Why? Because we got more productive. We got email coverage, so we could cover more clients. We could cover more people around the world. We could communicate quicker. We could communicate faster. I think AI is the next leg in this evolution of making us more productive. So, look, will there be a change in skill sets? Yes. Will people do jobs that they hate? No. The machine can input data. The machine can take codes out of an operating room in a hospital and input them into the insurance reimbursement system. By the way, that job in a couple hospitals has 40, 50% turnover rates because people hate doing that. They shouldn't do it. Those people in that hospital can now do a job where they try and work on recoveries and the hospital gets paid back. So I think you will see this natural evolution of people out of jobs that they don't like, jobs with low dissatisfaction ratings, to jobs that have higher satisfaction ratings that are more productive and grows the economy. That's the history of every other technological advancement we've seen. It's not overnight. That's why I call this an evolution, not a revolution.
All right.
And all this, by the way, and we probably won't have time, but remember, AI, I believe, is just a stepping stone to the real outcome, which is quantum.
Which is, I'm guessing you also think 10 to 15 years off.
No.
Sooner?
Sooner.
And how soon?
5 years. The strides that is being made in quantum right now are large. I mean, there's a lot more. Look, again, there's a lot of private capital going into quantum. It's big companies and small companies. It's all about error correction, how quickly you can correct error, how quickly you can compute. The data is pretty interesting right now. So, as we evolve, everything in this technology space is speeding up. So, 5 years.
All right, fascinating. I wanted to ask about regulation because you mentioned AI is going to help us create better AI, and I wonder what else AI is going to decide to do for us. Or do we need to regulate it? Do we need to have a heavy hand here, or is it okay to have a few South African billionaires just say, go?
I don't know what you're talking about. Yeah. I'll go to ChatGPT and ask that what that is. So look, the answer is yes. And I sit on a couple of these big regulatory boards around the world. So I'll do this relatively quickly. If it's a regulated activity today, if you use It should be a regulated activity using AI. So an example of that is, if I'm going to call my doctor and tell my doctor that I got a scratchy throat, a headache, a swelling of this, and he or she puts it in a machine, and they're going to diagnose my disease and prescribe me medicine, that's a highly regulated business today. The AI machine that does that and the program that does should be highly regulated. On the flip side, if when I'm working out tomorrow morning, Spotify chooses a bad song for me and I have to hit skip, which they do a lot, I'm not sure that needs to be a regulated activity. I can get through my workout in the morning listening to one bad song or skipping a bad song. So my view is, look, we've decided what businesses are regulated. We know what business should not be regulated. We should not use AI as a wedge to regulate more businesses. On the flip side, we shouldn't use AI to take businesses today that deserve regulation and take them out of regulation.
All right, we have one audience question here on tariffs.
It's amazing how you got an audience question on your card.
Does this strategy make sense to you as a way to deter illegal immigration and fentanyl smuggling from Canada? No, seriously. We've seen for a couple days in a row, markets really come down. We've seen rates come down from 480 to 420. President Trump has put 25% tariffs on our two closest trading partners after he negotiated possibly the greatest trade deal in history with them, right?
Yeah, USMCA.
Does it make sense to you? I mean, you were there.
So, look, I think what we have to understand, and I'm not saying I understand this, but I think what we have to try and figure out is what is the objective of the tariffs. And that, to me, I think that's where a lot of us are struggling. Is the tariffs meant to make foreign products more expensive so the domestic product is cheaper? Okay, that's a good use of a tariff. The problem is a lot of the things that we import, we actually don't make here in the United States. So you can make the foreign product more expensive. It doesn't make the domestic product cheaper because we don't have it. So that's a question I have. But if we put that tariff on, does that incentivize CapEx to build the capability to make that product? You could argue, okay, that's not a bad long-term outcome because, look, if we took nothing else away from COVID, we should have taken away from COVID, there are some strategic needs of this country that we are just too dependent on the rest of the world for, and we better figure out how to be more self-sufficient on necessity goods and items. So, when it's coming to buying personal protective equipment and we have to import it from China and we need sterile gloves and masks from China, probably something we should manufacture in the United States. If we're worried about, toys and games, we can live without them. I don't think it's a necessity item. So I think we have to figure out what the objective is. If the objective is to raise money for the government, make that the objective. I'm not sure how you do that. And how do you do that with weighing the effects of inflation on the other side? And I think you have to think about that. So if we're just using it as a revenue raiser, it creates a higher cost of goods. It's a really regressive way to raise revenue because I hate to say it, the reality of it is poor people or less highly paid people consume 100% of their paychecks. Wealthier people consume a very small percentage of their paychecks, and they have to consume their paychecks. So the things that are being tariffed are things that everyday people buy, and it becomes a really regressive tax system. I don't think we want a regressive tax system. I'm the first guy here that's going to argue for a progressive tax system. The rich people need to pay more in this country. They should pay more, and they do pay more today. I don't think we want to flip that around through tariffs. So to me, the question is, what is the objective here? There may be a real robust, bona fide reason to have tariffs. I just don't know what we're trying to achieve.
And you would know, I feel like. Anyway, that's a thoughtful answer, and I appreciate your time.
Thank you. Thank you.
Thanks so much.
about the markets because it is top of mind, and our Invest conference here is very timely. Mina Flynn is with us, co-head of Global Private Wealth Management at Goldman Sachs here at Bloomberg Invest. Hello, hello. You've been very patient. There's a lot coming at investors today. How do you make sense of this environment?
I think the number one thing that we have to remember is that when it comes to individuals, the first thing you focus on is portfolio construction. Portfolio construction drives 90% of a client's returns, and it's something that we talk about upfront and then on an ongoing basis with them. And the reason why this is so important is in times of volatility, such as we've had this week and that we've had today. And what you don't want is you don't want investors to be taking so much risk that they become uncomfortable and they sell, they crystallize a loss versus staying put or buying. But on the flip side, we want to make sure that we encourage clients to take enough risk so that they offset inflation on an after-tax, after-spending basis. So our portfolios are really constructed with investment-grade, high-quality fixed income, and then a good amount of equities and alternatives.
Let's talk about the equities first. In terms of geographic exposure for those equities, what has it traditionally been? And look, we know it's not a monolith. Every client is certainly different. But in general, how do you think about U.S. equities versus equities outside of the U.S.?
Sure. So we prefer U.S. equities, and we prefer that both in both public markets as well as private markets. Big picture, we have roughly about a 40% allocation to public equities. The largest allocation of that is to U.S. equities. And then outside of that, developed international equities. We do have a small percentage to emerging markets. But then also, I would say we have recently increased our allocation to private markets and to private equity, and specifically as it relates to buyout and growth. And the reason why is because these are two subsectors of alternatives where you see a significant amount of alpha relative to public markets, and also the distributions of returns is much more narrow than other sub-asset classes within alternatives.
In terms of private equity, are you upbeat about the ability to start seeing exits, which is something that has been really difficult over the last few years?
It has been difficult as it relates to public markets. I'm upbeat as it relates to private equity on two things. One is I do think to the extent that you have opportunities right now in public markets to be able to take companies private, I think that's an attractive opportunity for private equity companies. Second, I do think that there's a lot of opportunities for private equity companies in the private markets. So they don't necessarily have to only think about taking a company public or M&A as their only alternative to liquidity. So a lot of secondary private equity funds, a lot of continuation funds. The other thing I would note, although, is if you look at growth valuations in private equity, what you have seen is you have seen a normalization of valuations between public and private markets. And the reason why is because you've had really strong performance with these portfolio companies, and it's allowed these companies to grow into the target exit valuations that these GPs were looking for. So I do think once you have a little bit more stabilization in the markets, you're going to see more deal activity, both as it relates to IPO as well as M&A.
Okay, so let's talk about potential stabilization in the markets. Just in the last couple of weeks, we've certainly seen things change quite a bit. As Carol mentioned, at one point today, the S&P 500 had given up all its gains since that November 5th election. Tariff concerns about the economy. What's your outlook?
So I would just, the thing that I'm really thinking about is the sequencing of policies. And so if you look at the Trump administration, it is a pro-business administration. But what we're seeing right now is some of the negative hits to growth come first, whether that's immigration or whether that's tariffs. Before in the second half of the year, we're probably going to see some sort of tax reform as well as deregulation. And so I think what we've got to be mindful of is a little bit of that curve. Generally, the number one driver of U.S. equity returns is a growing economy. Even with the tariff rates that we're talking about right now, we still do anticipate that we're going to have positive GDP in the U.S. And so from here, we still do see equity market upside in the U.S.
So, Mina, you guys don't think about recession because it does feel like all of a sudden the narratives change a little bit. We've seen weaker consumer spending numbers, consumer sentiment numbers, manufacturing data. So no concern. GDP Now data, which we know from the Atlanta Fed, can be very volatile. But recession off the table completely for this year?
It's definitely not off the table. And we absolutely are looking, at the data, whether that's consumer spending, the jobs report this Friday is going to be important. But you're also looking at a growth of over 2%, 2.5%. And so we have the odds of a recession, even with these tariffs, relatively low, call it 15 to 20%. I do think it's important to just take a step back and just look at, we've got an S&P that's down roughly 1%. Year to date, right? We've got a lot of volatility, but we've got an S&P that's down 1% year to date. Okay, where you've really seen that underperformance is in the consumer, to the macro points that you were talking about, as well as in technology, just because you've had some of the growth decrease in earnings outperformance versus called the rest of the 493.
Right.
But outside of consumer and technology, all of the other sectors are positive. And so what I'm really focused on is the earnings path for the other 493. I think the Mag 7 is going to be fine, but what we're going to see versus 24 is likely a lot more earnings growth. So call it 3% in 24, roughly 8-9% this year. And so, and just your point as it relates to tariffs, we anticipate that every 1% increase in the effective tariff rate decreases growth by roughly 10 basis points and increases inflation by 10 basis points. So it is manageable. I mean, it's going to depend on what happens, how long those tariffs are in place, if they're rolling or not. I think if they're rolling tariffs, it's going to be much more hard from an inflation perspective.
Do you think that's up in the air? Based on just kind of the mode that we've gotten from the White House in the last 24, 48 hours, do you think that these are going to be lasting tariffs that stick around for a long time? Will there be more possibly? Or do you think that things could change in a week, in a month?
I think things could absolutely change overnight, in a week, in a month. And I do think that there's going to be incrementally more tariffs that we see on things like autos. And I do think that there's the opportunity to also make a deal with, Mexico, Canada in the near term and actually, have those tariffs reduced. And so I think the ultimate is we don't know what's going to happen. And the main thing we're focused on is that economic data.
Do you think that tariffs on Mexico and Canada are more damaging than tariffs on China? Because it does seem like the Mexico and Canada tariffs, there is this off-ramp when it comes to, what the president and his team have called essentially the border crisis and the drug war.
Yeah, I mean, I think
we don't necessarily see that off-ramp.
Yeah, when you look at 25% tariffs that you're talking about with Canada and Mexico, it's much more substantial than the tariffs that you've actually seen on China. And so when you think about that effective tariff rate right now, it's roughly about 8% if things stay as they have been announced. An 8% tariff rate would actually hit growth by roughly, call it, 80 basis points, and would increase inflation by roughly 80 basis points. That being said, we already had inflation coming down from where it is right now, and so we probably get to roughly a 3% level if that's the case. Again, it's not our estimate or our perspective that tariffs stay at these levels. But if that's the case, you still have an opportunity for the Fed to be able to react if you have inflation, even at that 3% level. And so what we saw in 2019 is the Fed cut as an insurance cut. And could we see that again today, or call it May, June, December? Absolutely, and I think the market's pricing more of that today.
That's exactly what traders are pricing in 3 rate cuts. What kind of blows my mind is, though, as you say, things could change quickly, overnight, in a week, in a day. And that's kind of the environment that we've seen, and we've seen it play out in terms of the rate environment. One thing I want to ask you, because I think there's been an assumption when it comes to President Trump, his tolerance of market volatility, that he was watching the equity markets. It was kind of interesting to see, I feel like, over the last few days where the markets certainly the equity markets had some problems. And we just had this assumption that President Trump would do something, say something. I'm curious what's the conversation you guys all have around that?
Yeah, I mean, definitely there
was the Trump put, whatever you want to call it.
Yeah, I mean, there's definitely the perspective that there was going to be a deal done, which is why, the markets are reacting like they are. And you do have a president that has really focused on pro-business policies. But at the end of the day, he's very focused on bringing manufacturing and jobs back to the U.S. And the question is, can we withstand that volatility? Can the consumer withstand that volatility? Can CEOs withstand that volatility and continue to invest in their businesses?
One thing I want to ask you, John Williams is coming up. He's going to talk with our Michael McKee. If you were sitting down with him, I mean, or what do you hope that Mike asks him? Because I'm curious. I think Mike probably a week ago had a different set of questions, and he probably does today. But what would you want to hear from John Williams, or what would you want to hear him talk about?
I guess I would want to know, as it relates to on the tenure, what's his thoughts as it relates to the tenure? We have a Treasury Secretary who suggested that he's watching that, right? And so what is the absolute level of the tenure? Why is it moving? How fast is it moving? And how does that play into their overall picture of kind of risk tolerance? And how does that then affect if they cut rates, they don't cut rates? And do they do that? Can they do that even with inflation? Call it if inflation does tick up to call it 3% or so.
We're going to be hearing from John Williams in just a minute, so we'll see what Mike asks. And before we let you go, Mina, crypto, is it part of the alternatives in a portfolio for your ultra-high net worth clients?
It's not part of our clients' portfolios, and the main reason that is because we don't see it as a store of value. It's very hard to actually value.
Oh, please
cryptos.
repeat that for the crypto folks in the back.
Yeah, so
You don't see it as a store of value, is what you said.
we don't see it as store of value, and it's a
Okay.
highly volatile asset. And it's hard under what valuation metrics do you actually value it? So no, we don't have it as a part of our core asset allocation.
All right, don't throw anything at Mina, crypto people, when you see her around, because she said what a lot of people think, I think it's fair to say.
Absolutely. Listen, thank you so much. So appreciate it.
Of course.
Mina Flynn, co-head of Global Private Wealth Management at Goldman Sachs here at Bloomberg Invest. Folks, we want to take you to the stage here at Bloomberg Invest. Our own Michael McKee sitting down with the president of the New York Fed, John Williams.
You're going to work against me on that one, right? John, we got to start with I guess you'd call it the orange elephant in the room, the tariffs that the president put on today. For a long time, you've been saying to me, it's too early to know the effect of the tariffs. Well, now we've got some details on the tariffs. Your reaction?
Right. And I think the reason I was saying to you it's too early is because it really matters. It matters, which goods or where tariffs are applying, what countries, how long they apply for. So there's, when you look at the research that looks at the effects of tariffs on the U.S. economy, one of the things that's highlighted, it depends whether it's consumer goods, it depends on whether it's goods that lots of countries produce, and a lot of things like that. So, it really made sense to let's wait and see, find out more about what policies may be put in place, and then kind of, come to, I would say, conditional judgments about what does it mean for the U.S. economy. And as you said, we are seeing more actual actions on tariffs in different dimensions. I would still highlight there's a lot of uncertainty. We don't know how long the tariffs will apply. We don't know what other countries may do in response to this. We also don't know what else may happen in this, in the kind of realm of trade policy. My own view is that based on experience from previous episodes, based on analysis, is that tariffs on consumer goods, especially, they do feed into import prices pretty strongly. That does filter in to prices that consumers pay. That happens relatively soon. Tariffs that feed into kind of intermediate inputs, the things that companies use to make other things and to make other things, those tend to pass through more gradually and have maybe last a little bit longer in terms of effects. My view is that, based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year. Not yet, but maybe later this year. I also, you have to factor in how does that affect economic activity, decisions by businesses to invest, consumers to spend. And that's where I think another big uncertainty is. We've seen some kind of movements in the data in the last couple of months. I think some of that's in anticipation of tariffs, so it's hard to really read the tea leaves there. But that's something else we'll be watching carefully, is to what extent is that affecting consumer confidence, business confidence, the uncertainty around this and the effects of the tariffs on economic growth and employment and things like that. So still a lot of uncertainty, I think directionally, somewhat higher prices in the outlook, at least in my kind of thinking about what's happening, but also a lot of uncertainty about how the economy responds to this.
The 2018 playbook for the tariffs in Trump 1.0, basically outlined by the staff in the Teal book that year, suggested that you basically had two options. You could raise interest rates to fight inflation, risk recession, or you could look through ignore the tariffs, assuming that they would be a one-time rise in the price level, but not an ongoing cause of inflation. What do you think this year? Which of those two playbooks should you follow?
Well, you're going to get a little frustrated because I'm going to answer the same way I answered the last question, Mike. And that is, it depends on how these, what goods, the tariffs apply to which countries, how long they're in place for, how big they are. So it'll depend on a lot of factors about how big the effects are and maybe how long these effects will last. I do go back to the broader context of monetary policy. It's not just about tariffs or trade policy. There's a lot of factors that influence the U.S. economic outlook and the global economic outlook. You have to take all of those into consideration, look at the totality of the data, look at the risks and uncertainties and what that means for achieving our maximum employment and price stability goals. So from my perspective, if you go back to the 2018 kind of briefing we got, clearly you want to think about how long-lasting these are, how big the effects are. But I would just reinforce this point. There's a lot of uncertainty about that, and we need to be guided not only by our economic analysis, by our absolutely fantastic staff who does all this work, but also what are we seeing in the data? What are we hearing from business leaders? What are we seeing in out there in the economy? And then from that information, kind of get a feel for which direction the economy is going, both in terms of inflation and employment. I mean, the good news here is the U.S. economy is starting in a very good place. Unemployment is 4%. The labor market is stabilized after cooling from red-hot conditions a couple years ago. Inflation is 2.5%, and it's been gradually coming down towards our 2% goal. So we're starting with the economy in a good place, and I would argue we're starting with the monetary policy in a good place, ready in a good position to adjust as needed, depending on how the data and the outlook and the risks of the outlook evolve.
Well, given the uncertainty you talk about and the time span before we might see things show up, is it fair to say that it's too early to consider changing interest rates at the March meeting?
Well, in my view, I think we need, I think monetary policy is in a very good place. It is, modestly restrictive. It is helping keep the economy, I think, in good balance. I expect the economy to continue to grow this year, roughly in line with, the economy's potential. I expect inflation would over time, move down back to our 2% goal. So I think monetary policy has got the right, kind of balance right now. It makes sense to collect some more information, not only about what's happening with trade policy, but obviously there's also what we're seeing in terms of other policies and fiscal policy and regulatory policy. So getting that whole picture, and then watch what's happening here in our country, but around the world, and put all of those together to see where monetary policy, what the appropriate stance of policy will be. But to answer your question, I think the current place where policy is good. I don't see any need to change it right away.
All right, there you go. There's one market moving headline. You mentioned what information you're trying to collect from the companies that you speak to. Are the CEOs as lost as the Fed and the rest of us in terms of what the impact of all this is going to be?
Well, I think when you talk to business leaders, the first thing that they tell you is they have to prepare for whatever happens. They're not sitting there having to guess, well, this is what will happen or that will happen, but really think through strategically about how to manage, different scenarios and how to behave. And I think one thing you're getting more of a sense of from some business leaders is kind of a view of, let's be cautious about making big business decisions right now. Let's get that additional information around what's happening in terms of this broad set of policies before making decisions. I mean, measures of uncertainty are pretty high right now, and I think people are taking that into account as they think about, maybe collect that more additional information before they make those decisions.
Well, as they try to put these things together, what's their underlying view of the economy and what they would do, and then how is this laid on top of it?
Well, my view coming into this, setting aside, say, some of the trade policy issues that we're talking about, is the economy is very strong, very solid growth. We've had very good productivity growth. We have a solid labor market, and the economy is in good balance, and inflation is coming down. So I think that's your starting place. And then the question is, what happens with various policies, and how does that, what adjustments do you have to make in your thinking relative to that? But I firmly believe that we're starting the year not only in where we are today, but the momentum we have is good growth this year, slower growth than say last year, but inflationary pressures coming down. Now, of course, you have to add to that any policy changes that affects that.
Well, that's the big question. What are companies telling you about their plans for dealing with tariffs? Are they going to pass them through?
Well, I think, again, it depends on which industry you're talking about. It depends on, some tariffs may apply to some industries or goods and not to others. I mean, right now, I don't hear people literally saying, here's how it works. I do go back to the experience of 2018 that you talked about, 2019. And also some of the experience of the pandemic. I mean, when producers or, retailers are confronted with much higher costs, they have to figure out what to do, and they're going to, try to pass that on to their customers as much as they can. They're going to try to find, probably some ways to adjust other margins of cost or prices, and other competitors and things may take actions as well. So I think there's no kind of plan that every business has for that. But based on history, what we've seen is, we see a pretty high pass-through of tariffs at least into import prices.
Well, in 2018, you were looking up at the 2% inflation target, and companies had no pricing power, and we were all very excited to go online and shop and get very big discounts. That all changed after the COVID pandemic. So does that set us up in a different way to deal with rising prices? Are companies going to say, hey, we did it, now we can do it again?
Well, I do think that you're absolutely right. The conditions back then where inflation had underrun our target, moderately for about a decade. We were looking for inflation to get a little bit higher on a sustained basis at 2%. And the economy was strong. The unemployment rate was low in 2018, 2019. So we're in a very good economy. And the actual policy actions that happened, both on fiscal policy and trade policy, I mean, they clearly affected the economy. We saw, I think, some boost to inflation, short-term boost to inflation. But it was in the context of economy that was, hadn't seen inflation for a long time. The experience of the past few years has shown that businesses have become much more attuned to how to figure out how to pass on cost increases. They feel they have more pricing power. They've flexed that pricing power quite a bit during the times of shortage. And I think, households also very sensitive to prices, a high cost of many goods. So I think it is a different situation today. And you see this in surveys and other, we talk to people. It is different than it was in 2018, where really there was almost a decade of no inflation. So I think it's a different context.
Well, speaking of surveys, recent surveys that have come out show people think inflation is going up, even at the longer term. The Michigan numbers for 5 to 10 years are up. Are you worried that Americans are going to be much quicker to sort of de-anchor their inflation expectations?
Well, it's obviously something I watch very closely. Inflation expectations, whether in surveys or from market measures or from economists, are something that's really important for us to study, to understand where the people are thinking about inflation, how they view future inflation, and that feeds back into the economy. So it's a really important topic. I can't help but point out that the New York Fed, we carry out our own survey of households, a survey of consumer expectations, and study every month the results from that survey. So it's something I take seriously. So what am I seeing in terms of the surveys? I think on the Michigan survey, clearly it's, the most recent readings have moved up quite a bit. That's something to watch closely. I'm not going to say it's not important. I do think that there are some aspects of the Michigan survey that might make it a bit sensitive to some spikes and things. We've seen that in the past, particularly kind of how they ask the question, how they collect the data. There's nothing wrong with it. It's just that we've seen that sometimes you'll get a big movement that gets reversed. In our survey of consumer expectations that we've done, at least for the data we have, which is not the most recent data, we haven't seen much of a movement in short or longer run inflation expectations, but it's something I'll be watching closely. One thing that definitely happens, and I think we're hearing from businesses, and I think we are getting this from, some of the survey data, like in the Michigan survey, is the talk of tariffs, the sense that there's higher prices out there is clearly influencing how people are thinking about inflation this year. I'm not seeing as much of an indication in most of these surveys that that's about long-run inflation or inflation in the future, but more about inflation in the near term. And clearly, people are experiencing some higher prices and are maybe more focused on that right now.
You have to come up with your own survey answers at the March 19th meeting. In December, when you put out the last summary of economic projections, it was widely assumed that was sort of a dead letter when you put it out because nobody knew what Trump was going to do, and by March, you'd have a much better idea. Do you have any better idea, or is this also going to be something we'll look at and go, we'll see you in June?
Well, if you look at my website, I have this thing about research interest, and it says monetary policy under uncertainty. And I think that's a good description of my job, because you always have uncertainty. You have uncertainty about policies. We went through the pandemic. We've gone through various events over the past several decades. So you're always dealing with that uncertainty and needing to make the best decisions. I do think relative to December, clearly some of the actions that have happened, even the discussions in Congress around fiscal policy have provided a better idea of the types of policies that we will or likely see. I still think that I don't have a lot of confidence in, say, the base case, that this is my forecast for the economy, this is where it's going. I'm much more in the kind of the mode of thinking there's a bunch of scenarios that could happen. We could see this happen, the tariffs be very short-lived, and then we move forward. Where there's others where it's much more permanent or different. And so it's really thinking through these scenarios, thinking through what the risks those imply for achieving our maximum employment price stability goals, and then how do we position policy for that. So it's not about getting the right guess about where everything's going to happen, but it's really just getting policy position right. So that's how I'm thinking about it. So do I have more information that helps inform that? Yes. But it's still, I think that the base case I would, or the one that we're asked about is kind of the most likely scenario, is not the only one that's important. You really have to think through all the different paths that we could be on.
Well, along with the summary of economic projections comes everybody's favorite diagram from the Fed, the dot plot. In December, you said 2 this year. The consensus median was 2 rate cuts this year. As of today, we've priced in 3 in the futures markets. Do you think 2 is still a baseline, or do you really have no idea at this point?
So my whole attempt to say I'm not putting a lot of weight on my base case didn't work at all, right? So I tried again. No, I'm kidding. I think it's really hard to know. I mean, right now the markets, as you say, they're pricing in 3 to 4 rate cuts this year based on futures. If you look at the modal expectation in the market based on options, it looks maybe more like 1 or a little bit more than 1 cut this year. And again, these are market expectations. I'm not making a prediction. I think that's actually really kind of informative. Market participants are trying to figure out, well, the modal case is something like 1 cut or maybe a little bit more, but there's just a wide dispersion of views out there, and it gets back to these scenarios. If you're in the market, you have to think about what are the different scenarios and position for that. Clearly, market participants are kind of thinking about some scenarios where they're protecting against scenarios where the Fed needs to cut some more than the base case. And I think what that's just reminding us is just there's a lot of uncertainty about the economy, about the policies. I'm always just focused on one thing, which is, how can we set policy and hopefully set a path of policy that, best achieves our goals. We're starting in a good place. Let's just try to keep the economy on the right track to get the inflation down to 2% over the next couple of years and keep sustain the strength in the economy and the labor market.
I want to switch over to the balance sheet because there's still a lot of interest in it. There are projections basically are going to stop QT roughly the middle of this year. But there's also a paragraph in the last minutes that suggests that you might stop it early if the debt ceiling is not resolved, because that could affect liquidity. Is that a real possibility?
Well, let me explain that notion. I mean, right now our strategy hasn't changed. The strategy is we want to continue to reduce our holdings of Treasury and mortgage-backed securities until we get the level of reserves to what we say is somewhat above ample. And that's something we study very carefully. We have a lot of information from market participants. We have various statistical and other analysis we do to try to measure, are we providing enough reserves into the banking system to achieve our interest rate control goals. So that is a strategy we put in place a couple years ago. We're still executing on that. One of the things about that strategy is we need to be monitoring what's happening in money markets, what's happening in the repo markets, the Fed funds markets, what's happening, in all these different indicators we're looking at. And with the debt ceiling dynamics that we're talking about here is that during a period of the debt ceiling, what happens is basically the Treasury spends out a lot of their money that they hold in account at the Fed. That actually increases reserves. As the debt ceiling is ended, that switches. And so you get big movements in the amount of reserves out there. There's really not driven by the demand by banks or the financial system, but kind of artificially moved around by kind of the dynamics resulting from a debt ceiling issue. And so the point that we're really making is we want to have a good view of what's happening in the money markets, in what's happening in kind of in general in there. And this is in a way making it harder to see what's happening because these other movements driven by the debt ceiling dynamics are kind of clouding that picture. So the idea of either pausing or slowing the shrinking of the balance sheet temporarily was really just to make sure that we're, while during a period where we don't see things as well, that, we don't inadvertently get to a place where reserves are lower than we intend. So it isn't a change in the strategy. It isn't a change in kind of what we're trying to do, but it's really about how do we best execute on that strategy in a way that achieves the shrinkage of the balance sheet without any market disruption.
All right, we're getting a little low on time, so I'm going to shorten my questions. We'll do something of a lightning round here. We know the Fed defends its independence as important for good monetary policy. Are you worried about Fed independence over the next 4 years?
I'm not worried about Fed independence. I am obviously, feel that Fed independence or independence of central banks in general is extremely important. We carry out our decisions, our analysis, everything we do is to achieve the goals that, that we've been given by Congress of maximum employment and price stability. We're just, everybody who works in the Fed is just committed to achieving those goals as best we can. It's not in any way influenced by partisan or political influences. I think the evidence internationally is having an independent central bank gives you better outcomes for the economy, for the people of the country. So it's not like I like independence because it feels good or it's comfortable. It's because it's been shown to yield better results in terms of inflation and economic results. And that's why I think it's really important.
You've started your review of the monetary policy framework. What is it you're expecting to find or do? There's been criticism of the Fed letting the economy run hot for too long. Do you need to get back to perhaps anticipatory rate moves to keep inflation in check?
Well, obviously we are in the process of reviewing our framework, and that will be a very thorough discussion of a lot of lessons learned. So I won't comment on that. I do think one important thing was with the previous framework, which was instituted in 2020, was heavily influenced by the basically decade of very low inflation, interest rates near zero for 7 years, and a very unusual environment, and designed to address some of those issues. But at the same time, it was designed to be able to set us up for success if the opposite happened, if we had high inflation or too. So although a lot of the attention on the 2020 framework was about the changes we made then, from 2012 through today, our framework has always emphasized the importance of achieving 2% inflation, price stability, always emphasize the importance of well-anchored inflation expectations. And I think just it has always been founded on this notion that price stability is essential for economic prosperity. So that's always been there. That's not going to change. And I think, and again, I'll just say, there was never any confusion about that, or in any way did our framework interfere with us making the decisions we need to make sure that we ultimately restore price stability.
Let me tie it all together in one last question, because we're basically out of time. But given what's happening on the fiscal side and in Washington, given your review and given where we are in the economy, are we looking at a regime shift in the U.S. economy, one that would lead to changes in the way you think about or perform monetary policy?
Well, I think, the economy the U.S. economy is amazingly dynamic. I know that's a theme here. We are the leaders in innovation. We are the leaders of, dynamism in the global economy. So you're always operating in a changing environment. Fiscal policy is part of that. Other policies are part of that change. But in my 30 years of the Fed, I've been through, many different cycles of fundamental changes in our economy. When I started out, we didn't have the internet. We didn't have a lot of things we take for granted. But I think, from my point of view, we always need to be open to the fact that parts of the economy, parts of the global economy are changing. And again, how do we take that into account, do our best to understand what that means for achieving our goals and make the right decisions? So are we seeing changes in, fiscal policy or trade policy? Yes, but in the broader context, I would say my whole career has been a time of various changes, and we just have to be good at adapting to a changing environment and carrying out our mission.
John Williams, thank you very much for joining us today.
All right, everybody, you have been listening to a live session here at Bloomberg Invest in downtown New York. I'm Carol Master along with Tim Stenovic. That, of course, was our own Michael McKee talking with the president of the New York Fed, John Williams. So if you missed any of that conversation, be sure to check it out at Bloomberg.com. Safe to say, every day we are seeing tons of headlines on AI. So we just kind of want to jump in and talk with our next guest.
Yeah, we got with us Dell Technologies Global CTO and Chief AI Officer John Rose here with us at Bloomberg Invest. He participated in a panel already on strategies for enhancing company value. John, look, before we get going, I just want to get an update from you on IT spending through the pandemic. If anything, today in like today's volatility that we saw in the markets, although it's kind of coming back in the equity markets. Are you watching that at all in the context of IT spend?
Well, there's two answers. In terms of AI spend, clearly that's a gigantic growth area. I think we've seen the TAM double in the last year. There's no doubt that we're on a track right now, and definitely in the global enterprise market, that probably the majority of IT spend in the long term is to build and implement the systems necessary to power the AI transformation of businesses. So pretty bullish on there. The consequences, in order to do that, we have to make the older systems more efficient. So there's actually a spend profile there of trying to densify environments and aggregate legacy systems. So the whole space is pretty active and looks to be a pretty positive environment, because without that infrastructure, there is no AI future.
John, we're like, what, over 2 years in, at least, that the market, the world, as you always remind us, AI, nothing new, we do the same thing, but certainly the narrative and the discussion changed more than 2 years ago. How has it evolved here in 2025? What's top of mind?
Yeah, I mean, so we're in year 3. Year 1 was experimentation with some tools that people couldn't really use for enterprise. Year 2 was the do-it-yourself era, that if you wanted to do it, it was a big technical effort. Year 3, we've now seen lots of ISVs, lots of turnkey offerings, and most importantly, companies like Dell.
Wait, SIVs?
ISVs, independent software vendors, people who sell you stuff. So instead of do it yourself, you can actually buy stuff to do AI, which is incredibly important. The two things that we need for enterprise adoption are, one, the ability to consume it as a technology as opposed to a do-it-yourself project, which that's actually happening now. And the other is a feeling that you're not the first mover. And because some of us big companies have moved first and have gotten to the other side of productivity, now there's archetypes to follow. So I'm pretty bullish about this is a good year in terms of expanded enterprise adoption.
We haven't gotten to talk to you since the DeepSeek news on January 27th that really wiped hundreds of billions of dollars from NVIDIA's market cap. We're down on NVIDIA about a little over 20% since the January highs for that company. Are you seeing any pullback in the space right now?
No.
In a word.
Yeah, and the reason for it is, look, DeepSeek was just another of 40 years of disruptions that have progressively moved AI forward. AI was a theory 40 years ago, and then we invented things and created new technologies and bent the curve multiple times to ultimately get to where we are today. Today, there's only 2 levers to make AI better. One is the MIPS per watt of the compute environment. Okay. Every time NVIDIA delivers a new GPU, that gets better. And the other is algorithmic improvement. Proceed to exactly what they did. I look at it as interesting engineering. It does look like some novel approaches using some existing technologies. Great, we need that. And what we've learned from it, because it's an open model, is there's some interesting techniques that other people are going to adopt. And guess what? It's going to make the whole AI industry more efficient. If there wasn't kind of insatiable demand in front of us, I'd be nervous. But there is. We have barely touched the processes of the enterprises in the world, and we have millions of them to go after.
But I do wonder, to Tim's point, that does DeepSeek make us rethink the models or the narrative about how the build-out has to happen, the energy needs, this cost, whatever it is?
Yes, it just like every other iteration, we're in a world. Welcome to the AI Club. The AI Club is an environment where there's constant disruption happening, moving the industry forward. And so the novel approaches in DeepSeek allow us to rethink, hey, maybe I can do training a little more efficiently. Maybe I can do inferencing a little more costly. Maybe I can develop a different way of thinking about a model. Great, let's adopt that, let's build on it. And the next one might be bigger disruption, but it'll still move the industry forward.
Got to ask you about Elon Musk and the government. Yep. And the goal is to make it more efficient. And there's, of course, a lot of news and a lot of headlines around what's going on in terms of what we've seen so far. What are your expectations that it becomes a more technologically advanced run government?
Well, I think, Elon,
and we should point out that Dell supplying servers to Elon's XAI.
And the government and everybody else in the world, we're very present.
We're there.
Here's the punchline. Elon's a technologist. He clearly understands the technology stack. The way you improve things, the way you get productivity, you do things better, is both the improvement of your processes and the application of technology to make those processes work more efficiently. Both of those are going to happen. I can't tell you exactly what's going to happen in the government. I can't tell you which play they're going to make, but what I can guarantee you is the end state, there will be more technology powering our government and our public sector, and it will probably make them more efficient and more effective. How it works out above my pay grade, but it is inevitable. The one thing I can guarantee you, there won't be less technology in the government when we move into the next year or the next 2 years.
Listen, I'm asking you this as a technologist, as somebody who has a front row seat on the technology side. Critics have said there are concerns about security and privacy when it comes to what Doge and what Elon Musk are doing. Should they be concerned?
I don't know. That's their opinion about maybe. You should always be concerned, and you should always look at the risk of technology. Here's a good example. We're maybe outspoken that for the real critical AI activities, you should do them in a private environment. Some people disagree with us. The reason we say that is because that's the lowest risk path. It also happens to be the lowest cost path. Every technology decision you make is a technology in a vacuum until you apply it to a real world scenario, and that's where the risk comes in.
So essentially what you're saying is if the Department of Government Efficiency employees are using AI tools to help with their jobs, they should be doing that in an environment that is secure.
You bet. And what that means to them, they should figure out. But what you shouldn't do is go into an environment when you're using technology without contemplating the risk of it. I have full confidence that any good technologist, including the folks doing that work in the government, are absolutely thinking about not just the technology in a vacuum, but the fact that when it gets into the real world, there are security considerations, there are other activities that need to be controlled, and you always build a security model into your technology architecture. Even LLMs have security models. Even agents have security models because that's necessary to make them work in something like an enterprise.
How should we be talking about, here we are in year 3, as you said, in terms of this stage of AI, is it a general purpose technology or is it going to replace everything? And I'm not trying to be like inflammatory or anything, but how should we think? Okay.
Neither. It is general purpose in the sense that we're going to see pervasive AI. It's going to be very hard 5 years from now to find any element of society that does not have AI as a partner, a coworker, an enabler. That is inevitable. But is it going to replace everything? Absolutely not. We've already seen this. Like when there's this new technology called agents that people are hearing about.
Right.
And they wonder, what is this? Well, the shift between a chatbot, the first generation stuff, and an agent is that the chatbot, the human was in the loop. You were part of the process. In an agent, you're still there, but you're on the loop, meaning you tell it what to do. You decide if it did the right thing. You're the boss. There's still a role for a human. It's a very important role, and the agents can't work without it. But our role in relation to these technologies is just naturally going to evolve because the technologies can do more of the underlying work.
John, you know what we want to know. Do we have a job going forward? That's what we really want to know. John Rose, thank you so much. So glad we could catch up with you. Global Chief Technology Officer, Chief AI Officer at Dell Technologies. John, thank you so much. All right, that's going to do it for this hour of Bloomberg Business Week. If you're watching on TV, the close is coming your way in just a moment. Tim and I continuing on radio.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
And a very good afternoon, everyone. Bloomberg Business Week continuing. We are on YouTube, we are on Bloomberg Originals, and we are, of course, on Bloomberg Radio. Carol Master, Tim Stanovic. We're downtown in New York. We're at Bloomberg Invest.
Yeah, Bloomberg Invest convenes allocators, deal makers, and investors from across the globe to track, dissect, and navigate the markets with the industry's most influential voices. Some people we've heard from or will hear from, including New York Stock Exchange President Lynn Martin, Carlyle CEO Harvey Schwartz. We got Bridgewater Associates CEO and Ariel Investments co-CEO, and we just heard from New York Fed President John Williams.
Yeah, and we're going to talk to our Mike McKee about that conversation in just a moment. On our air over the next couple of hours, Kathy Wood, we're going to hear from her and see what she has to say about the environment. We're going to continue these investment conversations. In the meantime, another volatile market session, but we should point out equity is definitely off their worst levels of the session. Let's toss it back to Uptown New York and to Charlie Pellet.
Hi, thank you very much. Volatile, one word. Remarkable, perhaps another word to describe today's sell-off and where we stand right now. Stocks dropped around the world earlier in the session as concern about the impacts of a trade war on the global economy spurred a flight to short-term bonds, gold, and haven currencies. But right now, we are looking at a major recovery for the U.S. stock market. How big, you ask? Well, NASDAQ is now up by 0.8%, up 147 points. This after steeper losses, down more than 2% in the early going. S&P right now down 6, a drop of 0.1%. We have got the Dow Jones Industrial Average down 234, holding on to a loss now of 0.5%. The 10-year on this tariff Tuesday, 4.20%, with the 2-year 3.94%. Spot gold up $24 the ounce, up 0.8%, $29.16. And West Texas Intermediate crude flat on the day right now at $68.39. Bitcoin in the green, surging 3.4%. Earlier today was trading around 82,000. Right now, Bitcoin 88,245. Austin Goolsbee, the president of the Chicago Fed, spoke this morning with our Barry Ritholtz. They spoke about tariffs and inflation. He is a voting member of the FOMC in 2025.
We have to slow down the pace of rate cutting until we get a sense of, is this going to be a temporary shock? What's going to be the magnitude of this shock? And what are going to be the reactions coming from the rest of the world?
Chicago Fed President Austin Goolsbee. Goldman Sachs is going to be targeting vice presidents in the next round of layoffs. This, according to the Wall Street Journal. Goldman will be cutting about 3 to 5% of its workforce, according to the Journal. Goldman shares down now by 2.5%. Again, recapping, S&P now little change, down less than 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. What a difference a few weeks make. We've been reporting how traders have added bets, expectations that the Fed will cut 3 times this year, concerns about tariffs, concerns about global economic growth. And a great conversation just coming off the stage here at Bloomberg Invest was with our own Michael McKee. He was talking with the president of the New York Fed, John Williams. Good to have you here. A ton of headlines coming out of it. I was curious, though, Mike, we were just talking about how much prep you do ahead of time. But a week ago or 2 weeks ago, were you thinking you might have a different conversation than the one you actually had today?
I would say I didn't know what kind of conversation, because we knew that Donald Trump was going to impose tariffs, and we knew that there's been a lot of chaos around the Trump administration, but we didn't know what the conditions would be today. And it just so happened that Bloomberg was able to convince Donald Trump to put the tariffs on today to make our shows more interesting.
Make Bloomberg Invest really timely.
But it obviously is going to drive the conversation about what happens with monetary policy going forward. So it was pretty easy to focus on that.
Well, John Williams said that tariffs will likely lead to higher U.S. prices. That is not something that the administration and members of the administration necessarily agree with.
And that's not something that the Fed has sort of emphasized in recent weeks. They've been very circumspect about it all, trying to stay out of it and telling us we have to wait and see what they're going to do. But now there's enough information out there that apparently they're ready to start saying this is going to be an inflation issue. Now, as John pointed out, we don't know yet how much of one. He said pass-through to consumers would be fairly strong, especially for finished goods. And then it's a little harder to know in the intermediate goods area how much of that gets passed along and how fast, but that there would be more inflation from this. And that didn't suggest to me like he's in any hurry to cut interest rates unless we see the economy collapse.
Is he worried about economic growth?
He's not worried about economic growth going into all of this because the economy was in very good shape coming into the year. What he isn't sure about is where we go from here. What kind of effect is this going to have? And he mentioned, we talked about consumer confidence. And if confidence evaporates, then you've got a real problem in the economy. And it's something he said we have to watch closely.
What about when it comes to independence of the Federal Reserve?
He said he wasn't worried about it. Obviously, the Fed continuously says an independent central bank is important because that's when you can do monetary policy best.
Doge hasn't really made its way into the Fed.
You know, I've been asking around at various Fed banks, and no 20-somethings with computer coding stuff have come into the banks. They are set up legally a little different from most government agencies, so it appears that Doge might not have access to the Federal Reserve, and I don't think that even if they did come in there, they'd let them into the computer systems.
That would be kind of interesting. But anyway, anything that surprised you in your conversation with John Williams up on stage? I mean, they tend to be very careful, right? And
right. Well, not a surprise, but he did say that there's no need to change rates now. I asked him if what he was saying about uncertainty and we have to wait to find out what happens, if that meant that they were not going to change rates on March 19th, then he basically said yes, there's no reason to do that right now. The economy's in a good place, monetary policy's in a good place, and we don't have an idea of what is going to happen.
But if we do know now that tariffs have been imposed on Mexico and Canada, and prices indeed do go higher, and perhaps we see some inflationary effects from that, how does that change the outlook for the Fed this year?
Well, it all depends on, and I'm going to sound like an economist here, it all depends on how all this comes through to the economy. Because if there are one-off tariffs, if Donald Trump changes his mind tomorrow and takes them off or something like that, or if we just have this wall of tariffs hit now, it'll raise prices. But then prices will stop going up because they went up once. So that's not an inflation issue that the Fed needs to react to because higher interest rates aren't going to change the price level. So that's what they need to figure out. Now, the way Trump has talked about putting on tariffs with tariffs going on today, tariffs going on next week, tariffs going on April 2nd, that could create more of an inflation issue because you're continually adding higher prices to the mix. Obviously, Americans aren't going to be happy about paying more at the grocery store, and they're not going to be happy about paying more for gasoline. I don't know if you noticed that the gas buddy guy said in the Northeast, for our Boston listeners, that they could go up 40 cents a gallon this week. So
explain how that works with oil prices falling on a day like today.
Well, oil prices are only one component of all this. There's the refining issues, and then oil prices we talk about in a generic sense, West Texas Intermediate, but all these refineries use different grades of oil. And in the Northeast, there's a lot of a heavier oil that you get from Canada and some other places. And if that's going to go up in price, then that's going to increase the cost of the refiners, and they're going to pass that along to you.
Somebody like Donald Trump would say it's an example of why we should be using energy that is produced here in the United States.
Except that there's, the energy we produce in the United States differs all over the place. Now, the Bakken shale up in North Dakota is more similar to the heavy crude we get from Canada, but the stuff we're getting from Texas, as they like to say, is light sweet crude.
Yeah.
Nice name. It's like a George Carlin thing. Nice name.
It's the name of Joe Weisenthal's band.
Exactly.
Light sweet
crude. And that's a completely different kind of oil, and the refiners, different refiners can't use these different oils. So it's going to be a price question, and energy is going to be one of the first areas to feel it.
Mike, you talked about, if we continue to see more tariffs being imposed, that would be tougher on the economy. I mean, I am thinking about what we've got right now. Can the U.S. economy, is it strong enough to kind of manage, if this is it, manage it?
When you go to the gas station and you have to pay more money, how are you going to react? That's really the question here, because recession is a confidence issue.
Yeah.
If people feel that things are going to go badly, or that prices are going to go way up, or they might lose their jobs, then they stop spending. and they start holding on to the money, and then companies are making less, and then they're hiring less, and you get into a recessionary spiral. We haven't seen one like that in a long time because the last couple of recessions have been basically finance-based now, and the COVID was its own generic thing. But the traditional kind of recession could come along. We can't rule that out. So it's something you want to keep an eye on the confidence figures and then watch what people do. Do they keep spending or does that slow down?
Can I just say a little informal Twitter survey?
Oh.
Like, are you spending or holding back? And more people said that they're holding back. I'm not saying that this is a good sample or, but it's just interesting to see. I'm hearing that from people.
Last week we had the PCE spending report. The savings rate went way up. And people spent less money. The savings, the spending levels went way down. So at this point, it looks like people are maybe pulling back down. Is that a 1 month thing, or does that continue?
Yeah, John Williams still telling you the U.S. economy is in a good place.
Well, it came into the year in a good place, and people were feeling good. We spent a lot of money over the holidays, and companies had plans for capital investments, and now everybody's kind of sitting back and going, wait, let's see what's going to happen. Now, does that translate into, okay, we better stop? Or does that like, okay, we can live with this and get back to what we were doing?
Mike, you have reported on so many different economic cycles. And yes, there are those extreme cases like the Great Financial Crisis or a pandemic where, everything just kind of falls off a cliff. Having said that, I feel like 2 weeks ago or 3 weeks ago, we weren't even using the word recession in a conversation. And all of a sudden we are. And again, I know you talk about the importance of sentiment, but as someone who sees cycles, when we start to talk about it, does it necessarily mean that, okay, it's more likely that people are starting to, you know what I mean? If they're starting to talk about it and it's part of their considerations.
It probably is a little bit more likely, as they say, Wall Street has predicted 7 of the last 3 recessions. It doesn't mean it doesn't mean it's going to happen, but it is something you want to keep an eye on. And we've had some backup to this, the weaker spending reports, and then the Atlanta Fed GDP now, which people completely misunderstand what it is. It's not a forecast for what GDP is. It's like given the data we have today. It's a snapshot in time.
Yeah,
this is what
it is called GDP now.
Yeah,
right. Which is why it moves around so much.
Yeah, and it moves around tremendously through the entire quarter.
Yeah.
But that got into people's minds on Wall Street, and then it starts to scare people, and then they start writing about it, and then people are reading about it, and then they start thinking about it.
Hey, one thing we haven't gotten a chance to talk to you about is what Washington, D.C. looks like in the wake of the Doge cuts. Just anecdotally speaking, heard of a guy down there who did lose his job just in the wake of what's happening. And he's essentially saying that in his neighborhood, half the families are now one-income parents because of job cuts just in the last few months.
I was just down there yesterday, and I can tell you, I lived in Washington for 20 years, and it's the most depressing place